Meet the MC, Wole Famrewa is an award-winning anchor, producer, and former West Africa editor at CNBC Africa.
Yes, good morning. Thank you all for joining us for the conversation around the future of banking. We're delighted to host this. This is, of course, hosted by CNBC Africa. My name is Wole Famrewa. Before I go on, I would like to again appeal. I see quite a few of us are seated towards the back. If you'd be so kind to move closer to the front, we'll really appreciate that. Let us try and fill up the seats towards the front. So if you can just keep it to the first 5 rows, that'll be fantastic. Thank you so much as you do that. So today we are here for a very, very important and I think very timely conversation. Just interacting with some of our speakers today, I'm learning a lot already, and I'm sure you're going to learn quite some. So it's not so much to entertain you, but it's to inform you. The future of banking is here, and what does that reality look like? Now, that could be as an operator or as a consumer yourself. There's so much to learn in terms of what has changed and what is coming. So I really look forward to having that conversation today. Of course, I want to appreciate our distinguished speakers and captains of industries in the room. Of course, beginning with the Governor of the Central Bank of Nigeria, Mr. Olayemi Cardoso, who is ably represented, and I'll be making some introductions later. We also have leaders, of course, from government. Captains of industries are joining us today. We have the regulators, we have the innovators. It's going to be a very, very valuable learning experience, I can tell you that. As you probably know, because you have registered for the event, the theme of today's event is institutions, technology, and money in a post-recapitalization era. So the lenders in Nigeria have gone through a process which ended recently, and that capital now needs to be deployed. And as they consider how they will deploy that capital, I think the learnings from today's event will be very, very valuable indeed. But beyond that, we have so many other players in what you can describe as the banking space. So traditionally, you would think of banking as the brick and mortar companies that provide lending and deposit services. But I think the concept of banking obviously has evolved over the years, because you don't necessarily need those brick and mortar companies to carry out banking services, and you don't need those companies as well to actually provide banking services as well. So we'll see how things have evolved as we continue this interaction today. So you're all very warmly welcome to this. And I just wanted to, just some housekeeping points that I would like to emphasize. This event is being broadcast, so really appreciate it if we can be mindful of our movements during the session. We have scheduled breaks, so you will have the opportunity to interact with other participants during the day. So, and of course, we do have coffee all day. And as we proceed, without further ado, I would like to, first of all, just draw your attention to a short presentation to set the scene for what should be a very valuable and informative session.
The future of banking.
The future of banking in Nigeria, institutions, technology, and money in a post-recapitalization era. Nigeria's banking sector is entering a transformative chapter. Following recapitalization, institutions are tasked not only with strengthening their balance sheets, but also with redefining their role in a rapidly evolving financial ecosystem. The future of banking will be shaped by 3 components: institutions, technology, and money. Institutions must balance stability with innovation. Banks still earn people's trust by being strong and reliable, but they need to adjust to a world where digital platforms, fintech partnerships, and flexible business models are taking place. Technology is no longer a supporting tool. It is the bloodstream of modern finance. Artificial intelligence, blockchain, and mobile banking are driving inclusion, efficiency, and personalization, making financial services more accessible than ever before. Money itself is undergoing a profound metamorphosis from paper and plastic to digital tokens and mobile wallets. The definition of currency is expanding. The shift demands robust regulatory frameworks to ensure transparency, security, and systemic strength in a digitizing economy. In this post-recapitalization era, Nigerian banking is about shaping prosperity, where institutions safeguard trust and technology fuels progress.
Of course, that video sort of captures the conversations that we're going to be having today. We're going to talk about who owns the customer, for example. It may not be what you think. And then, of course, the whole very important and valuable conversation around inclusion. And I think there are two layers to that. There's making that inclusion happen, but of course, how potentially you can profit from that process. And then another very important conversation is around the evolution of technology, things like artificial intelligence. It's something that I think many people underestimate, the computing power required to do a lot of things in the era of AI. So we look forward to unpacking many of these conversations as we move forward in today's event. Without further ado, I'd like to now invite to deliver a welcome address to further set the scene, if you like, and to help us appreciate why CNBC Africa is doing this. I'd like you to please warmly welcome with an applause the Chief Financial Officer of the ABM Group, Mr. Tamishan Surya.
Tamishan Surya, Chief Financial Officer at ABM Group and Executive Director, West Africa.
No problem. Thanks. Cheers.
Good morning, everyone. Your Excellency, Mr. Olayemi Cardoso, Governor of the Central Bank of Nigeria, who is unavoidably absent, distinguished representatives from government, regulatory institutions, esteemed speakers and panelists, our valued institutional partners and sponsors, captains of industry, ladies and gentlemen, good morning. On behalf of CNBC Africa, it is my great pleasure to welcome you to the Future of Banking Nigeria 2026. We are truly honored by your presence and grateful that you have chosen to spend this morning with us, discussing one of the most important sectors shaping not only Nigeria's future, but also Africa's economy. I would like to begin by expressing our sincere appreciation to our institutional partners, the Central Bank of Nigeria, the Chartered Institute of Bankers of Nigeria, and fintech NGR for their leadership, support, and collaboration in making this event possible. I would like to thank our valued sponsors, Zenith Bank, FSDH Merchant Bank, MoneyPoint, and Open Access Data Centers, together with our knowledge partner, PwC Nigeria. Your support has enabled us to bring this together, some of the brightest minds in banking, technology, and public policy to engage in conversations that matter. At CNBC Africa, we believe our responsibility extends far beyond reporting the news. For the last 19 years, CNBC Africa has been Africa's leading pan-African business news and financial news platform, reaching 30 million homes across the continent. Every day, we tell Africa's business story, connecting investors with opportunities, showcasing African innovation, and creating platforms where ideas become action. Nigeria has always been central to the story. Since establishing our presence here in 2007, Nigeria has become one of CNBC's Africa's most important markets. We have reported on Nigeria defining economic moments, from banking consolidation and financial sector reporting to the emergence of world-class fintech companies major infrastructure investments, and the remarkable resilience, innovation, and capital markets, not only within Africa but globally. We see ourselves as long-term partners in telling Nigeria's growth story and creating platforms that help shape its future. Today's conference is another important chapter in that journey. At CNBC Africa, we believe meaningful conversations lead to meaningful outcomes. When regulators, financial institutions, technology companies, investors and policymakers come together with a shared purpose that creates solutions that strengthen economies, improve lives, and lasting priorities. Nigeria's banking sector has once again demonstrated its resilience through the recent recapitalization program. Yet, recapitalization is not the destination. It is the beginning for a new chapter. The real opportunity lies in how stronger institutions deploy capital, embrace technology, deepen financial inclusion, face economic growth, and position Nigeria as a world-class leading financial market. At the same time, banking is evolving at an extraordinary pace. Artificial intelligence, digital infrastructure data, cybersecurity, and new payment technologies are redefining customer expectations and transforming how financial institutions operate. Success in this new environment will require more financial strength. It will require vision, innovation, and collaboration and leadership. That is why today's theme, institutions, technology, and money in a post-recapitalization era, is so relevant. The future of banking will not be built by banks alone. It will be built through collaboration between regulators, financial institutions, fintech technology providers, investors, and policymakers, all working toward the common goal of creating a stronger, more inclusive, and globally competitive financial system. We are privileged to welcome an exceptional group of speakers whose expertise span regulation, banking technology, academia, and financial advisory services. Their insights will undoubtedly help shape the next phase of Nigeria's financial services industry. At CNBC Africa, we remain committed to creating platforms that connect leaders, inspire meaningful dialogue, and help shape Africa's future. Thank you once again for joining us today. I wish you an engaging morning, insightful discussions, and valuable networking. It is now my honor to officially welcome you to the Future of Banking Nigeria 2026. Thank you and enjoy the conversations.
Thank you very much, Tamisha, for setting the tone and helping us appreciate why this conversation is very important. And without further ado, we'd like to move on to the first of several learning moments as I invite the Governor of the Central Bank of Nigeria, Mr. Olayemi Cardoso, who is unavoidably absent as noted in the welcome address, but of course ably represented by the Director of Statistics Department at the Central Bank of Nigeria. I'd like you to please put your hands together for him as he comes to deliver the keynote address, Mr. Usman Opanachi. Switch on.
Good morning, everyone. Industry leaders, distinguished guests, ladies and gentlemen. I have the honor this morning to present the address of the Governor of the Central Bank of Nigeria, Mr. Olayemi Cardoso. who sends his apologies for his inability to be here in person. With that said, permit me, ladies and gentlemen, to proceed with the presentation of the keynote address by the Governor of the Central Bank of Nigeria. Distinguished chairmen and chief executives of banks, managing director of CNBC Africa, chief executive officer of ABN, leaders of the fintech community, regulators and policymakers, investors, partners from across the continent, members of the press, ladies and gentlemen, good morning. It is both an honor and a privilege to address this distinguished gathering at the Future of Banking Summit 2026. Let me begin by thanking CNBC Africa and the ABN Group for convening this gathering and for choosing a theme that captures with remarkable precision the moment in which our industry now finds itself. We are indeed in a post-recapitalization era. Of course, that phase carries the weight of something completed, but I wish to suggest this morning that it more accurately marks the beginning of a new chapter. This address is structured in three parts. First is where we stand, followed by why payments sit at the center, and then we will be concluding with the discipline that decides everything, where we stand. 2 years ago, when the Central Bank of Nigeria directed banks to strengthen their capital base, there was no shortage of skepticism. Some of which, by the way, were not entirely misplaced. The thresholds were demanding 500 billion for international banks with proportionate requirements across the national and regional categories. There were warnings of disruption, a credit squeeze, and widespread distress. Nonetheless, the program proceeded and concluded on 31st March 2026, having mobilized 4.65 trillion naira in fresh capital. 33 institutions met the capital requirements applicable to their licenses. Perhaps most significantly, about 73% of that capital was raised domestically from Nigerian investors who chose to invest in Nigerian banks. The balance came from international markets, which in our view was a powerful vote of confidence in our financial system at a time when global market has had no shortage of destinations. We should, however, be careful not to misinterpret that outcome. Recapitalization was never an end in itself. We did not ask the industry to raise capital merely so that balance sheets will appear more impressive. We did so because a bank's capital ultimately determines the level of risk it can responsibly absorb on behalf of the real economy. The scale of transactions it can underwrite, the shocks it can withstand, and the confidence with which it can finance investment and consumption. Given where we are today, the question is no longer whether the envisaged capital was raised. Rather, it is about what will we now do with the capital raised. A stronger banking system that lends timidly has missed the point. The capital that has been raised must find its way into the productive economy, into small and medium-sized enterprises, agriculture, infrastructure, and businesses that create jobs and earn foreign exchange. That is the deployment challenge. It belongs to us as much as it does to you. Why payments sit at the center? This brings me to the subject our hosts have asked me to address directly. The Payment System Vision 2028, which the Central Bank of Nigeria launched in Abuja only a few weeks ago. I often describe payment infrastructure as the invisible road upon which money travels. It is a deliberately simple analogy. We rarely think about roads until they fail us. We simply expect them to be safe, reliable, and capable of taking us where we need to go. Payment systems earn public confidence in exactly the same way, by becoming so dependable that people scarcely think about them. Like roads, they are strategic national assets. The speed, security, and reach with which a country moves value increasingly determine its competitiveness. Nigeria does not begin this journey from behind. Over the past 2 decades, our payments ecosystem has become one of the most dynamic in the world, driven by instant payments, fintech innovation, and the expansion of agent banking to approximately 2 million agents nationwide. In several respects, our performance compares favorably with that of many advanced markets. PSV 2028 builds upon these achievements. It is not a response to failure. It is the next phase of a success story that we must not take for granted. The vision rests on 6 guiding principles. First, interoperability by default. Value should move seamlessly across platforms, institutions, and borders. That means only when our payments rails are built on open standards rather than walled gardens. No Nigerian should have to think about which bank, which wallet, and which provider sits on the other side of the transaction. The money should simply arrive. Interoperability is not a feature we bolt on at the end. It is the foundation we build on from the start. Second, security by design. I want to be candid. A payment system is only as strong as the confidence people place in it. Infrastructure can expand and products can multiply. Yet, adoption will stall the moment people fear their money is not safe. So risk management, cybersecurity, and fraud prevention must be embedded by design rather than added as an afterthought. Our ambition is straightforward, though demanding. A Nigerian's money should be safer within the digital financial system than anywhere else. Third, inclusion first. Universal, affordable access must become the baseline, particularly for women, young people, micro, small, medium-sized enterprises, and underserved rural communities who have too often been left at the edge of the formal economy. Our goal is to achieve 95% financial inclusion by 2028. Tens of millions more Nigerians holding an account or a wallet in their own name, protected by their own verified identity. Digital payments should increasingly become the preferred means of everyday transaction, while cash continues to play its legitimate role within a modern and inclusive payment ecosystem. Fourth, innovation with purpose. We will adopt modern technologies, open APIs, the ISO 20022 messaging standard, artificial intelligence, and a central bank digital currency where it is genuinely fit for purpose, not for their novelty, but for the convenience, efficiency, and competitiveness they deliver. Our open banking framework has already opened well over 100 application programming interfaces. The aspiration now is that Nigeria moves from being a fintech adoption market to a fintech production economy. That the next global competitive fintech is built in Lagos, in Abuja, in Kaduna, on Nigerian data and Nigerian infrastructure, and exported to the world. Fifth, trust through transparency. Trust is the currency that gives every other currency its value. It is earned through transparency, accountability, effective consumer protection, and reliable dispute resolution. That means clear service level agreements that operators are held to, dashboards the public can actually see, firm enforcement of people's rights over their own data, and consistent, reliable redress when something goes wrong. Confidence does not come from telling Nigerians the system is sound. It comes from letting them watch it work and giving them somewhere to turn when it doesn't work. Sixth, and finally, collaboration for scale. None of this can be delivered by the CBN alone or by any one organization. It calls for alignment among regulators, operators, the states, civil society, and every other stakeholder around shared outcomes and coordinated execution. And it extends beyond our borders as trade depends. Under the African Continental Free Trade Area, the friction of moving money across the continent becomes a tax on African commerce itself. Through the Pan-African Payment and Settlement System, PAPS, and our broader regional integration agenda, we intend to position Nigeria not merely as a participant in global finance, but as a leading driver of Africa's financial integration. The discipline that decides everything. I will conclude with what I consider the most important point. Nigeria has never lacked bold ideas. What has too often been missing is consistent implementation. Our history has sometimes been characterized by ambitious launches, followed by inconsistent execution. That pattern has come at a high cost because the benefit of financial transformation accrue only when reforms are sustained. For that reason, I repeat what I said at the launch of the PSV 2028 and what I will continue to say. The success of the Payment Systems Vision 2028 will not be measured by the quality of the document. It will be measured by execution. Whether the previously unbanked farmer gains access to financial services, whether fraud declines, whether a Nigerian fintech grows into a globally competitive enterprise, whether the cost of cross-border payments falls. Execution cannot rest with CBN alone. It requires banks to deploy their strengthened capital with ambition and discipline. It requires fintechs to innovate securely. It requires telecommunication companies, payment operators, regulators, development partners, and ultimately every Nigerian who uses the financial system. I have called PSV 2028 a Nigerian project, and I meant it. It belongs to all of us. We have recapitalized our institutions. We have articulated a clear vision for the future of money and the technology that moves it. What remains is the patient, disciplined, and often unglamorous work of building a financial system that every Nigerian can trust and from which every Nigerian can benefit. That is the task before us. Let us be the generation that not only imagined the future, but built it, and built it very well. Thank you, and God bless the Federal Republic of Nigeria.
Apanachi, for that keynote address, of course, delivered on behalf of the Governor of the Central Bank of Nigeria, Mr. Olayemi Cardoso. And there's quite a few takeaways from that. It's clear that the Payments System Vision 2028 is a big focus of the regulator, and as you know, you have to align with the regulator. So all the learnings from that speech, I believe that all our operators in the room have taken away the key messages of the central bank as we continue to unpack what the future of banking looks like in Nigeria. So we'll be moving on to our first panel conversation today. It's going to be a conversation about who owns the customer. So a bit of an edgy topic, and I think there will be so much to learn and unlearn as we unpack this. It may not be what you think. So before we get into that, I'd just like to turn your attention to the screen as we introduce our panelists. And as we do so, I'll encourage them to please step forward to join us on stage.
Chijioke Dozie, co-founder and CEO of Carbon.
Please a round of applause for him.
Kachi Nwabweze, VP Global Marketing and Growth at Grain. Innocent Isichei, Executive Director, ACIOE Associates.
Hi.
Dele Alabi, Executive Director, EcoBank and President, Chartered Institute of Bankers of Nigeria. Moderated by Wole Famrewa.
We are expecting one more speaker. I believe he will join us on the stage. The president of the CIBN will be represented by the registrar. And so at some point, we may just be interrupted as he steps forward and joins us on the stage. So great to have you all. Okay, sure, of course, please. Thank you so much for joining us for this very, very, what I think should be a lively and interactive and informative conversation about who truly owns the customer. And I did say earlier that it may not be what we think. Let me go to Chijioke first. You're the co-founder of Carbon. Carbon has been what I would describe, and we'll be talking about this a lot as we go along, the digital-first platforms that are really changing the game in terms of the interaction with customers, banking customers, traditional banking customers. So if you can, just give us some perspective on your experience dealing with customers in your field and how, to the point that we are speaking about in this panel in terms of who owns the customer, what can you tell us about your experience in terms of your experience with the customer that perhaps many in this room would not know?
Sure, thank you. And thank you for CNBC for inviting me on this panel. I think my view on our view in Carbon, the customer is sovereign in terms of who owns the customer. A lot of our customers bank with all the banks. So, you know, I don't see a Carbon customer as Carbon's only, but I see it as, you know, the customer is sovereign, it's their data, it's their transactions, and we as financial institutions have to earn the right to work with them. And, you know, when I think about the whole debate about who owns the customers and banks, financial institutions, digital businesses like Carbon, when we say this is our customer, I'm always reminded about, you know, my experience, my personal experience when I was in South Africa.
Right.
You know, I was working for the World Bank and I banked with Standard Bank, and Standard Bank was my, you know, they would say they owned me, but then when I went to them for a mortgage, they gave me such a horrible rate. ABSA gave me a 30-year mortgage. I switched, you know, so like all of a sudden, you know, it just shows that if, as a financial institution, you really have to put your best foot forward every single time when you're interacting with a customer. You cannot take that relationship for granted.
Right.
And I think I'm very excited about open banking, and when open banking is fully operational in Nigeria, I think a lot of us financial institutions will have to set up, because all of a sudden, you know, relationships are up for grabs.
Yes, and okay, so let me perhaps unpack that theme about who owns the customer a little bit more. Because interacting with people now and giving the services that are available, what we may find is that a customer who is dealing, especially with the digital-first platforms, is not only receiving banking services, it potentially is receiving accounting services, is receiving financial advisory services, and is receiving potentially the upselling of other financial products in a very seamless manner that makes their lives easier. So everything from risk management, insurance, and so to the point that it's really about the customer experience as opposed to, like you said, just where the customer is situated. So maybe you can speak to how the dynamism that we're seeing in the customer relationship from your viewpoint.
So I think it's changing. So when we started in 2012, 2014, there was still that need for that physical interaction between customer and bank, customer and financial institution. And the relationship between a Carbon customer and Carbon was very transactional. But over the years, a couple of things have happened. I think people are getting more comfortable with digital transactions. I think banks also pushing customers out of the branches into ATMs. The banks also legitimize digital channels. I think you're seeing people just wanting to get their products and services quicker in a more convenient manner. So,
the speed and convenience is really the name of the game now.
You want 24/7 service. We have customers who email us at 11 p.m. at night, and they want an answer.
Right.
And so we have to find a way to give them an answer at 11 p.m. at night. So that's what's evolving. So customers are demanding more and more touch points at every single time.
And of course, there's the issue of latency in terms of service experience.
Yep.
I was speaking to one of our other speakers earlier today, and it's really something that changes the experience of the customer. And it's actually one of the ways that you are potentially going to acquire new customers or lose the customers you have right now. So maybe as I segue to Ikenachi, I just want to hear your perspective. You can tell us a little bit more about Gray as you do so, but because you are doing a lot of cross-border related transactions, speak to how the customer experience is changing from your viewpoint.
Can you hear me?
Yeah, they're going to switch you on now. Go ahead.
Okay. So I really like Chijoke's point about...
Okay. You may need this. Go ahead.
Great. I really like Chijoke's point about who owns the customer, because technically nobody does. Right? You don't get one customer and then say, this is my customer, and then they don't, try other services. People want ease. People want to be able to, get access to their money wherever they want it. And what this means is that at every point the user has to make a transaction, regardless of if your product is like traditional finance or a digital first platform, you are regaining their trust. So trust is consistent over the number of transactions that they're making with you. It's not a once and done situation, right? And when you keep that in mind and, come to cross-border payments, which is historically not the fastest, transaction in the world. When you look at like SWIFT and certain other rails, and then look at wanting to, give customers the same, let me use a Nigerian customer, the same kind of speed that they would experience when they do like a local transfer.
Right.
You realize that the battle that you're fighting is kind of big, because I know from my experience at Gray, one of the hardest things that we've had to communicate to, let's say, users in Nigeria is that international transfers don't happen as fast as, your local transfer does. But then the thing is, these customers, they don't really care. They just want their money, and you can kind of get it, because at the end of the day, what matters to users is not just income. Income, it's what their income can do. They want to be able to pay rent. They want to be able to pay their bills. And then when you're talking about this is not possible because you might need to wait for 2 to 3 days, you're losing the chance to, quote unquote, to borrow your word, own that customer,
Right.
right? So what we've had to do is find ways to be creative about how, one, you're presenting this information to people, and two, you're making that access possible. So what we're able to do is, say, okay, we're able to give you like a wallet that supports local payment rails abroad. So if you're trying to send money, let's say from the UK to someone in Nigeria, or receive money, from the UK, we can give you an account that you wouldn't have to use SWIFT. You'd be able to use a local UK payment rail, which means that you can get it in minutes, right? And you would be able to sort out all the other payments that you want to do. And for us, that is an important touch point in latency, because then we now know that, okay, we don't have to worry that we're going to lose this person, because what matters to them is that they're able to do their transaction at the speed at which they want it, and we've been able to solve the problem.
So what would you say gives organizations like yours the edge over the traditional banks in terms of transaction frequency and speed? Maybe you can take us to your back end and help us appreciate what's going on there.
I would say it's definitely not, quote unquote, being a startup, right? Because you can be a small startup and you can still be boxed down with a lot of bureaucracy, right? So I'd say for us, it's really the unit of design, right? So for everything that we do, we keep in mind that the people that we want to serve care about X, Y, Z. And I would say for a lot more traditional companies, that's kind of not how it works. Like, strategy doesn't start from the customer. But for us, strategy starts from the customer, right? And that kind of shapes what the organizational structure even looks like, right? And then that kind of shapes like our roadmap. That kind of shapes the features that people, the features we choose to work on, because we're looking at data of what people care about.
Right.
We do a lot of, I'd say, I know that you asked for a comparison. Compared to traditional products, they might be focused on like KYC data, but we do focus on that compliance, and then additionally focus on behavioral data. How people who, for example, get money into Gray and keep it, and how people who get money into Gray and spend it immediately act. Those are two very different kinds of customers, right? And you need to be able to sit back, look at that data and say, okay, so who am I designing for? Like, if I want to get these people to do X, Y, Z things more, how do I shape my product in a way that allows them to do that more? And because we're able to do that, I would say it kind of shapes what the organization kind of looks like. It shapes what our roadmap looks like. It shapes how fast we're shipping features, because it's more than just creating like a strategy deck, or just, saying, okay, you have this team and that team. It's more about, okay, so we're seeing this data, and it makes no sense if we're not able to like action it. Like, if we're not able to use this data to actually like drive what the organization looks like. And let me give an example. So when we first started, right, and we have like a lot of people using like our products, for personal users. But then something we started seeing when you look at like transaction history, because you're doing like transaction monitoring, monitoring for AML, we're seeing like large volumes of transactions coming into personal accounts. And then you're seeing who these amounts are going to, and then you're observing that, people are actually trying to use this for their businesses. But then at that time, we didn't have a business product, right? So that data that we were able to see kind of helped us say, okay, you know what, maybe we need to create a business team and start working on a business product, versus, just coming in and saying, we're just going to stick to, personal banking, there's a product team, there's an engineering team, and that's all we're going to do. So I'd say the difference is that we use data to shape what our organization looks like and shape what our customers want, versus sticking to, very rigid, this is what you're going to be able to do with the product, and that's it.
Right. Thank you so much for that. Innocent, before I come to you, I want to go back to TJOK, and maybe you can also speak to the advantage that you have in terms of the nimbleness, the speed to innovate, compared to, say, a traditional bank. How would you compare your experience? You want to take that.
Oh, sorry, my bad. I think we're...
It's on. I can hear you.
I think we're unburdened with sort of legacy systems. When I think about, our core banking platforms and the ability to analyze data and analyze transactions quickly and come out with insights is maybe one advantage that we have in terms of being able to be nimble. And I think also, the background in terms of, I'll give you an example. I used to, yes, I did, have a finance background, but I also was an operator of Mr. Biggs. So I know when a generator is down, I need money, and I know how much my cash flows can support that. So I've seen it from the SME side of things. So I know I can sort of relate to some of the SME merchants when they're looking for capital, and I know what they can what they can actually finance. So I think those are some of the advantages. I think sometimes being closer to customers. I think also not having the luxury of a certain type of customers. Look, as microfinance banks, as fintech companies, we can't deal with big corporates. So we haven't got access to that revenue stream. So what do we have? We have to then make do with the market and create a market. And I think, when you talk about, one thing I'm finding is that the nature of SMEs are changing. When you think about 10 years ago, 15 years ago, when you think about an SME, you think about a physical building, you think about a shop, etc. Now, you have lots of Instagram merchants that are selling products. You have some of you today came via Uber. I mean, that's an SME because he or she that's their business. Independent contractors, exactly. Some of you use Chowdeck to eat. The people there who bring your food are independent contractors. They need financing, but they're not SME in the old traditional way. So I think financial institutions have to change in line with the changes that the ecosystem is also experiencing.
All right. Thank you so much for that. Innocent, before I get you to begin to comment on perhaps some of the regulatory issues and how we situate all of this in that, maybe you want to chime in on some of the conversation we've been having so far. Your thoughts about who owns the customer, that evolution.
Thank you. Good morning, and thanks for the question, and thanks for the kind invitation. Just listening to the conversation, and as well as the speech by the governor, represented by Dr. Kwanachi, one thing that struck me is really the idea that the growing focus is really on the user in itself, right? As opposed to the institution in itself. And that has really been helped by, to a large extent, by this issue of interoperability of the payment network. And I think that has helped to push the conversation, because imagine if you didn't have an interoperable system. What you would have had is, to a large extent, the customer would have been owned by the institutions that owns the rails. But by opening the system up, right, the conversation shifted away from the institution in itself to the user. And by opening that system to fintechs, in addition to the banks, what you saw was increased competition on how you could actually provide services to the user. So, and to a large extent, what you now saw, you also began to see disruptions as maybe greater adoption of mobile devices. What you then began to see was competition around cost, service quality, settlement times, right? You saw institutions trying to compete around, can we actually deliver a payment in 3 seconds, right? Because it mattered particularly in the consumer segment of the market, right? And as a result of that, you've also seen, or for merchants, how fast can I receive a payment, right? For a small business, those things are very critical. And so as a result of that, you saw major disruptions, particularly in those segments of the market, whether in the retail segment of the market, where today maybe you see particular, maybe a mobile money provider have maybe close to maybe 40 million accounts, right? Which I don't think any, most of the commercial banks will have maybe 40 million, will I say, retail users. At the same time, you also saw in the SME segment, right, where fintechs like maybe MoneyPoint, for example, if you look at the depth and breadth of the agent network in itself, and it was really driven around this issue on focusing on the customer, the service quality in itself, the cost, because these things mattered most to the customers. The space I'll be looking to see whether these disruptions go to eventually is really around the corporate segment of the market, which to a large extent is still dominated by the conventional banks.
Right. Would you say, though, that the Payment Vision 2028 roadmap that has been articulated and launched recently addresses equitably the issue about distribution between the banks and the fintechs? Or do you think that we want that to be tweaked somewhat? Is anyone getting an unfair advantage here?
To an extent, I remember when I think there was this conversation a couple of years ago about telcos, banks.
Right.
And I remember having a conversation with a friend of mine, and I said, the number one thing that's very important is to maintain that interoperable system. That's very, very important. And making sure you don't have exclusivity of agents. Right? Once you can have those rails open, right? You then have...
It's fair game?
Yes, a fair game. To a large extent, the degree of... and you could see it, right? And it was also, when you also look at other countries where you had systems like this, for example, even in India, where you had, everyone expected the telcos to dominate when they brought in telco providers to come in. But at the end of the day, it was like a fintech, Paytm, that dominated, right? Because the competition, the dynamics of the competition changed. And I think that we saw the same thing in Nigeria here. Yes, you granted payment service bank licenses to telcos, but at the end of the day, those who actually eventually won, who owned the customers to a large extent, were the fintechs. And I think you just want to continue to stir the competition, and which is ultimately focused on the user. I think I like what the central bank has done in terms of maintaining that emphasis on interoperability. I think just ensuring that, issues around exclusivity, you also make sure that agents are non-exclusive, right? Because that ultimately helps to drive competition in itself.
Right. Thank you so much for that. We'll be coming to the audience in a bit, so if you do have questions for our panelists, please get them ready. But before I do that, let's focus again on the customer, this time the SME customer, and how, maybe going back to Chijioke, how you are powering distribution for SMEs. Your business model, how does that help the SME scale, so to speak, its business?
So in terms of distribution, I think that we're not as, let's say, big as some of the big financial institutions in terms of distribution where they have 600 branches. So what we're doing is we're trying to embed finance in existing networks. So, what that means is, for instance, we're going to a big drug supplier and financing their customers. So
right.
So enabling that drug supplier to help finance people that want to, like pharmacies that want to purchase from them. And that does two things. It expands our distribution piggybacking off other people's networks, but it also reduces our risk because, we're getting a lot of data from even that vendor-supplier relationship. So that's how we're trying to mitigate the fact that we haven't got the ability to have 1,000 branches or have 20,000 agents. It's going to establish networks and enabling businesses to finance their customers because they know their customers better than we do.
Thank you for that. Going to Gray, maybe we can, a similar question for you because you do more cross-border type enablement in terms of the service you provide. So maybe you can speak to how you are helping businesses scale as well.
Okay, we have a business product which is fairly new, but it's giving us so much information into two things: what people think they want, and what they actually want, right? So the things that matter to a retail customer are very different from the things that matter to business customers. Business customers are a bit more patient, right? They understand that not every transaction is going to clear immediately, so they're fine with that. And I would say also at the same time that business customers are kind of easy to retain compared to, retail customers, personal customers, because I would like to say it's not only based on the fact that they run their own business, but at the same time they kind of understand like the structure. So for us, as we're building our business product, we're making sure that we are able to be a proper business partner for these businesses. We're in an age where everything is digital, and with that, commerce is also digital. So it means that most people are providing services, both offline and online, to consumers outside of where they primarily reside or where their business primarily operates, right? So they want to be able to do things that they would be able to do in their local currency, in other currencies as well. I would say, additionally, what we're also trying to do is, I'd say maybe beyond access to our platform, beyond additional, this is like a long-term plan, beyond additional like add-on services to the product, perhaps we're also starting to see, okay, you know what, how can we, properly support you through, to offer your services to like more markets. So for most people, that looks like, I want to be able to make payments in more currencies. Like, so right now, I'm using this product and I'm able to make payments in just, let's say, Nigerian or just to Kenya or just to India. But I also say that I have customers in South Africa. I also say that I want to be able to receive payments from suppliers in China. How is that possible? So for us on our end, we really want to be able to solve that big problem, right? On how you're going to be able to get money in and get money out when you're building a business that is serving people across multiple markets.
Thank you for that. Innocent, I'll come back to you. And as you just chime in on the point you made earlier about interoperability being very important, but especially when we consider across borders, what else do you think is key that will allow the many other digital-first platforms and even traditional banks thrive in the new economy of the world?
I think we've done very well, I think, domestically in terms of instant payments in Nigeria. And I think you're gradually seeing countries beginning to think about the model here in Nigeria, whether it's in Kenya, or whether it's in South Africa with PayShap, even in Ghana. One of the areas that we really need to think about is really cross-border. I think she's spoken extensively about it. I think about it from two layers, right? So if you look at payments coming in from other parts of the world into Nigeria, right? One of the things, at one point, I think the costs were really roughly about maybe 7-8%, right? And it was something, I think, which the central bank did, which was very helpful, right? And I think maybe in 2024, in terms of the regulation around pricing, for example, stirring up more competition. So you saw more licenses that were being issued to IMTOs in itself. And that helped to, it stimulated a lot of competition in the space. So, and I'm sure she probably knows that. You saw prices fell, right? So Nigerians in diaspora, or maybe even folks who are trying to send money to Nigeria, particularly from the US, from Europe, or maybe from the UK, the cost actually fell, right, because of this competition. And I think the existing payment rails, and we know one of the things that you talk about is also the issue of stablecoins, right, in the PSV 2028 plan. But the challenge, the other aspect, I think, is really on intra-Africa, right, where the costs still remain very high. The points of frictions, you still find those points of frictions. And I think it's an area that I think more efforts needs to be, what you've seen in some other clients is getting their payment systems to talk to each other.
Is that because the regulator is not enabling that, or
I think
what exactly
the existence of the rails to a large extent. For
the rails actually do not.
The rails, yes. So now
there.
building those rails, and that's the reason why we talk about PAPs, right? That's the reason why PAPS came to be, in that the idea was create those rails that would enable that connectivity, payment connectivity within Africa in itself, right? And you've also seen people also say maybe you could also leverage other tools, like maybe, for example, stablecoin in itself to support those cross-border payments within Africa. I think that's one area I think the PSB also talks about. The other aspect which we've also seen is also getting payment systems to talk to each other. For example, how does JIPS in Ghana talk to NIPS in Nigeria, right? And so that could also enable faster payment between the two countries in itself. And I think people have also looked at it as a testing model. You see that in East Africa, right? I think maybe that could be, you weren't thinking about PAPS, maybe having multi-pronged options of, you have PAPS in itself. You also have a system whereby you can get some of the domestic payment rails to talk to each other, like say Ghana, Nigeria, or maybe Nigeria and Kenya, for example.
What about the telcos? We haven't spoken too much about them, but given their infrastructure, given their client base, they can be a very, very strong competitor, if you like, and potentially could stifle the growth of others. How do you situate the telcos in this whole conversation?
It's very interesting, maybe just looking at it and studying and also speaking to some of the operators in this space. Initially we expected this big bang from the telcos, but maybe because, number one, by the time they were trying to play, I think the level of innovation in itself, I don't know whether some of them were fast enough to...
So you think they're a bit behind the curve?
Yes, I actually believe that they were behind the curve, right? So I think the level of innovation itself by other players to some degree sort of affected their ability to dominate in the space. So if you even look at their numbers today, across the three telcos that have, will I call it, some sort of banking payment licenses, the amount of the customer base is still relatively low compared to the other players in the industry. So I think the idea is how they are able to provide, really shape the user experience, the quality of service, and ultimately the cost. I think those things are very important.
But could they be an asset? Could they be an ally as the others try to scale? I'm opening this up to others to speak to this.
I think so, ultimately, right? They still have a good distribution network that you can leverage on, particularly as we seek to drive inclusion, right? We saw the goal of, I think, 95% inclusion rate by 2028. So the idea is how do you also, you could sort of see how can they also work with some of the fintechs in general in seeing how they can really get down to that last mile, right? I think even when you look at their metrics, they, low margins but high volume. So maybe they could also help working with some of the fintechs and the banks in deploying, some of the services down to the last mile.
Chijioke, do you want to chime in to speak to how the telcos can play a critical role here?
Yeah, the telcos have lots of rich data. In fact, telcos do a lot of airtime lending, data lending. So that, I think, that should be, I think how they could help, and this is controversially, I think they could help feed that data to credit bureaus, because I think that's also an issue where lots of lending is going on in one pocket, and I think this is about the customer being sovereign, right? My point is, if I am borrowing airtime and I'm doing this all year round, and I'm paying back, and yet First Bank, Carbon, Moneypoint don't know about that at all. So when they're coming to us for a loan, we just think you're invisible. Meanwhile, for the last 2-3 years, you've been borrowing money, airtime, data, and you've been paying back. So I think it's also about making sure that that data is also in a central pool, the credit bureaus or credit or a registry, where where then other institutions can assimilate that information and make a decision. So I think that's where the telcos can really help.
Right. Thank you for that. You wanted to add something to that? Go ahead.
I was going to add, because I think one of the, sort of what Chijioke was speaking to, I think this whole idea of open banking, I think is something that could really, really help to change the dynamics.
You want to describe that briefly, especially for those who may not
So the whole idea is, to a large extent, you have an account with a bank. And the idea is, to some degree, it looks like the bank owns your data. But imagine if
that data you have, the data on your transactions, your activity, is being able to be shared with other institutions, right? So now what that forces your bank to do is that your bank begins to compete with other institutions that might want to lend to you, may want to provide other services to you, may want to assess your credit worthiness. And I think one of the things if you look at the payment system vision, it talks about, the steps that I think the bank is taking to implement this. And the way you've seen in other countries, it really, really helps to, diversify the sort of product services that customers have access to. And so you're not confined to your customer, but it also speaks to what Chijoke said on customer sovereignty, right? Ultimately, it's really, really about the customer, not necessarily about the institution itself.
Indeed. I wonder if Mr. Murakio is in the room yet. We were expecting him to join the panel. I guess not. Okay, but you wanted to say something on the last point? Go ahead.
I think that at the end of the day, though, the thing that we might be overlooking is customer education, right? Because from my perspective and background in marketing, all of these ideas only work if the customer understands what it does for them. So if we're not at the same time making, allocations in our budget to actually go down to the last mile user to educate them about, this is what this does, this is how it helps you, we might not be able to, see the kind of growth that we want to get if we don't also invest in that education.
All right. Thank you for that. Unfortunately, we don't have the registrar of the CIBN in the room, but I want to throw this to the panelists now to perhaps speak to something I was hoping they would speak to, and that is on the issue of the utility of physical branches in the future of banking. Now, I know it may be a touchy subject for some, but I want to hear your thoughts on this. Who would like to go first? Innocent?
I'll probably say to some extent, the brick and mortar business has sort of changed in itself as you've seen greater adoption of, call it mobile devices or mobile applications. I myself rarely go to the bank, right? And before, you go to the bank to maybe open an account, to make payments, and maybe even to have access to a loan. But the level of competition we're seeing now, that is really changing. I'm sure Carbon, you don't necessarily need to, like most of your customers are really, they come in online, right? They don't necessarily come to your physical branch. There's still a case to some degree, particularly when you have maybe low literacy levels. So customers may feel that to some degree they want to have the touch point to be able to know who the institution that is warehousing their funds or providing services to them. So I think maybe as you have more literacy, it may reduce the need for better customer service in itself. May reduce the need for bank branches in itself.
But what about risk management? Because as even with the evolution of technology, it's also the innovation in fraud as well. So I do get the sense, especially in places like United States, these branches still exist. They still welcome people to come in, to sign them up, to add layers to the services. Maybe that's perhaps the biggest case for it.
Yeah, yes, I think. But if you look at the U.S. in itself, you're seeing a reduction in the number of bank branches in itself because you're beginning to see more people are leveraging more of the digital channels. There's still the case to be made particularly where you have the literacy levels. But you talk about fraud, which is a big issue, right? It's a growing issue as technology. You see greater adoption of technology. Fraud is going to be something that you have to keep your eyes on. And I think the way you look at it is, I looked at the payment system vision, and one of the things I liked about it was this whole idea of, being able to share intelligence across networks, across the different payment institutions. Because what you want to prevent is a fraudster who, perpetrates fraud in one system, going to another system, and maybe it goes to another institution, they're not aware that this actor had maybe perpetrated fraud in another system, but being able to have that shared intelligence, at least that will help to reduce, this incident of fraud in itself.
Right. You want to speak to this too?
Yeah, sure. I think,
I take a different view. I think that what's going to happen is we're all going to try and move for efficiency, so reduce bank branches. But then what we're seeing in other markets is actually an increase in bank branches, because I think trust is a big issue. If we had an app...
On both sides, I imagine, from the client side and the institution side.
I think Citibank had this study in the 80s where people were more willing to pay back if there was a branch if they could see a branch in a neighborhood. So that's why Citibank was everywhere. And I think branches still play an important role. I think it's how they're designed, how they are, and what they do. I mean, we talked about customer education. So imagine a branch that is cashless. And so you already reduce the cost because you don't have a safe, you don't have the security, but it enables a customer to come in and she can get help. So I think there's still a lot of use for that. So for me, I think branches still play an important role. And in Nigeria, we don't really have. I think the biggest branch network is about 600 branches. South Africa, Pick and Pay stores, Pepco has 3,000, and now they're becoming a bank. So I think, but if you look at the branches there, they're cheaper. They're
it's a design issue.
So if branches can be redesigned whereby you don't need a lot of capex. So you have branches where it's cash, so there's needs for security. But there are branches that are also sort of, onboarding, KYC, customer education. I think that's how I think you can spread financial inclusion. So I'm all in favor of that.
I hear you. Thank you so much. I'd like to open this up to the audience now. And so if we do have questions or comments on this topic about the customer, we'll be happy to hear you share your thoughts. So if you do have a question, please signify by raising up your hand. I see a hand over there already. Please introduce yourself briefly and please direct your questions so we can get some answers.
All right, good morning. I'm Iklima Musa and I work with the National Information Technology Development Agency. My question is on ethical use of AI. So responsible and ethical use of AI that is going to be embedded into the systems for credit worthiness. One, how is that done? How are you applying it into your system? Now, in terms of open banking, how do you think it's going to accelerate competition and also enable the market going forward? Thank you.
All right. So the issue about ethical, what exactly did you say you want? Sorry, can you give her the microphone again, just to clarify the ask?
So the first question is, for instance, Carbon already uses AI in their system, right? How are you embedding responsible and ethical AI for credit worthiness? That's credit scoring system for consumers. Then secondly, the question is on open banking, which is the future of banking. How is that going to protect consumers and at the same time accelerate competition?
All right.
Thank you.
I would also just say, though, that we do have another session that will be speaking to many of these issues, but I'm still happy to hear from our panelists.
I mean, so on ethical AI, I mean, I'll be honest, I don't really understand the question. But in terms of, we've been using machine learning for our credit scores, and at the end of the day, it's the information we get in, and that's why it's so important that we have access to lots of data via the credit bureaus.
If I can just chime in, I think one of the concerns regarding ethical use is that, one, there's a feeling that some people may be left out because AI, for example, may not necessarily be perfect. So I guess maybe that's one of the concerns.
Well, I mean, I think a lot of people are being left out because there's just no access to data. When I think about some of the safest customers to lend to, the woman selling, I don't know, akara on the streets, she's probably been there for years. She's not going to run away. If you lend to her, she'll probably pay you back. But all her transactions are in cash.
So if you look at, but if she was in Kenya and she was using M-Pesa, she gets funded by, NCBA because they have access to it. So we're having a lot of people left out currently because the transactions are not being digitized. So I think that's one. And also we have lots of people as well who are being left out because their airtime lending purchases are not being reported to the credit bureau as well. So that's how. So the more data, more of that comes in, we'll be able to include more people. And then in terms of open banking, it really, as Innocent said, it really means that if you're with a bank and they're seeing your transactions and you're going to the bank and you say, I want a loan for a car or whatever, if they don't give that to you and other banks have access to the same data your bank has for the last 10 years, they can say to you, we'll give it to you. You haven't banked with us a day, but we'll give it to you. And that's, for instance, what happened in South Africa. I was banking with Standard Bank for 3 years, never walked into an ABSA branch. ABSA looked at my data that Standard Bank had and said, I'm going to give you a 30-year loan. And I walked. So that's the opportunity in Nigeria with open banking, where a bank can be with you for 10 years, and some other bank can look at that same data that you've built up for 10 years with another institution and say, I'm going to take this relationship. So it means that your bank has to put their best foot forward every time. So they're now working for you every single day, because the minute they don't put their best foot forward, there's maybe 200 institutions that can say, I'll take this over.
Right, but I think one of the concerns around ethics around open banking is data protection. So I guess you want to speak to that briefly.
But the customer has to approve. So the customer has to consent to your...
Data being shared.
Yeah, so like for instance, there's a bank statement service right now where if I want to make a loan to you, give you a loan, I need your bank statement. I can apply for this service, but you have to consent to say, yes, Carbon can have my bank statement. I can never just fish it out without permission. So open banking requires customers to be in control at every single point. And that's why customers should be sovereign and will be sovereign in the open banking system.
Got it. Thank you so much. We did have another hand up at the back. You have the microphone? Okay, please.
Thank you. Good morning. I think my questions are just in two folds. First is about trust. And I think I would like you to shed more light on that. Customers, there's this war presently, banks and fintechs. So what do you think, about customers at this moment, their trust between banks and fintechs?
Sorry, when you say trust, as in the customer trusting
the customers trusting,
the
yes,
banks
more than the fintechs, yes.
Oh, they trust the banks more than the fintechs. Okay.
So how do you try to be able to navigate that? I think that was the second question. How do you plan, for fintechs to circumvent, such customer skepticisms when you have that? Thank you.
Okay, that's an interesting one. Do you want to speak to that?
Can you hear me?
It's not on. Sure. Yeah, go ahead.
Okay.
It's not on.
I think it's okay. Oh, that's an age-old question. So the thing is, trust is not something that you gain once, right? So the fact that I have used your product, or I have used, I'm speaking from the fintech's point of view,
sure.
Right? The fact that someone has used your product and it worked doesn't automatically mean that they will just trust you, because we're in a bit of a low trust society, right? So this means that we have to work harder to gain customer trust. And the best way with which we do that is transparency. And I think that every fintech that I've seen come out of Nigeria prioritizes this, right? If people know exactly where their money is going, how much you're going to take from them in fees. They kind of start to, and especially if it's a compounded behavior, and they start to see that like play out over time, their barriers start to lower, and then gaining their trust subsequently becomes easier, right? So transparency helps us solve that, and at the same time being available. Chijioke made an example when he was talking about the future of banks, where people want to get help at every point in time, right? So I have a problem, and at 11 p.m. I'm reaching out. If there's nobody to solve my problem, it kind of makes the trust battle harder, right? Because I start to wonder, is there somebody on the other end of the line, especially when your product is digital first and people cannot exactly see like a physical office situated somewhere. So another way I've seen like fintechs try to solve that is being always on, like being available 24/7. 24/7 support is something that, I'll use my experience at Gray, is something that we decided to do again out of behavioral data.
I imagine that's been tough.
Yeah, that's hard, right? Especially because we have users all around the world, right? So somebody who is reaching out to you from somewhere in the Philippines doesn't care that your team is based out of Lagos and you're GMT +1. They want their problem to be solved. So how do you get that customer to trust you? It means that you're able to provide them help, right, when they need it, and that kind of also helps, solve the trust problem, transparency, and being always on. I hope that answers your question.
Yes, I think it is a process. It's not something you gain, and of course, many of the traditional banks have a heritage that's more or less oozes trust, so to speak. I think I hear you on that as well, ladies and gentlemen. Unfortunately, I cannot take more questions, but this is obviously an evolving conversation. We have to move on to our next segment, but I would like you to please put your hands together for our panelists. I think they've provided some very valuable insights that we can use, not just as users, but of course as operators in this space. Thank you very much. Can we just step forward for photograph, and then I will invite the moderator for the next event, for the next segment. Thank you very much to all our speakers. Very good. Thanks so much. Appreciate it. All right, I would like to now invite David Alabi, who would be introducing the next segment of today's event. David Alabi is an anchor with CNBC Africa. Please, a round of applause for him as he steps forward.
Hello everyone, good morning once again, and it's a pleasure to be here as we mark quite a wonderful job the panelists did. One round of applause for them. Hello everyone. Yes, now we can hear each other clearly. Thank you once again for being a part of today's event. This is a flagship of CNBC Africa, and we're happy to have you here as we mark the future of banking events. Thank you so much, Wale, for quite the interesting conversation, and then our panel speakers for also challenging our thinking as we continue to look at the bigger picture of financial inclusion here in Nigeria, and also tread much more strategically as we lead the African pack. Now it's time for a fireside chat, an interesting conversation to continue from where the Director of Statistics from the Central Bank of Nigeria earlier talked about some of the policy direction priorities of the Central Bank of Nigeria. Now, kindly, with a warm round of applause, welcome once again the Director of Statistics at the Apex Bank, Central Bank of Nigeria, who joins me for a fireside chat. Welcome, sir. Yes, please. So I think I'll hand over the microphone now to you. Interesting. So today's discussions have really, should I say, challenged our thinking, broadened our perspective, and when we have industry players give feedback, it's also important to have the clearer reassurance from the Central Bank of Nigeria. We've already heard from them earlier on, but I want to still speak to you in representation of the Governor of the Central Bank of Nigeria. Wonderful work we did with the recapitalization exercise, but if we were to come back here for the same summit in the next 2 years, what would success look like from this pillar point we've recorded?
Morning once again, and I think to the panelists that just lectured, that was a very inspiring conversation. The MD CNBC Africa said in his speech, meaningful conversations produce meaningful outcome, and looking ahead, I expect that the conversations we're having now should lead to some outcomes that are significant, that are meaningful. And then from the point of view of the Central Bank of Nigeria, see, recapitalization, the governor was very clear in the speech that I read, was not meant to be an end in itself.
Yes.
It is supposed to be a means to an end. And so 1 year from now, we should be seeing the, clearer outcomes in terms of how the institutions that have recapitalized have been able to deploy that capital, that strength, towards supporting the economy.
And for businesses and households in Nigeria, we're talking about financial inclusion here now. One of the big questions is, what will the banks do with this extra money at this point in time? These are buffers to ensure we have financial stability, but will this translate now to lower borrowing costs, funding for the real sectors of the economy?
Yeah, so you're right. As a regulator, that's our outlook, right? And I think that's the outlook of every, person that means well for a system. Yeah, we look at a situation where, the institutions have enhanced capacity, and then they translate that capacity into efficiency, and then, of course, to, cost reduction over time. So, it is not capital alone that is going to deliver that, but capital is going to be part and parcel, of the various elements that should ultimately lead to, cost reduction and better customer experience,
yes,
over time.
Yes. And quite interestingly as well, I like the fact that you highlighted the payment system vision 2028. That's another pillar point the market is also watching quite closely. But what would you say are the current biggest bottlenecks we have prevailing in our Nigerian market, and why it's also important to pivot, especially as we look towards positioning Nigeria as one of the world's most efficient payment systems?
Oh, great question, and I think in part this was addressed by the last panel. And I start with the very basic one, which is around interoperability.
Yes.
Right, and this is also connected to the concept of that open banking. Now, if systems can, interface and, it makes payments seamless, better, right? So that challenge is still there, and as a regulator, we have a responsibility to create the kind of environment that will enable operators to do what.
Let me tweak that question. How would compliance be enforced?
Sorry?
How would compliance be enforced?
Oh, compliance, great. You see, the thing is about
First of all, we want to see a situation where operators feel and see the need to comply on their own, not doing it because there's some regulator watching, right? So compliance is about doing things according to predetermined procedures, processes, rules, and ultimately they make the system better. So we would like to see a situation where this is done voluntarily, where institutions, small, big, right, see the benefit for them, for their own image, and of course ultimately for the customer when they try to comply. So it is good for them, it is good for the industry, and of course it is good for the regulator.
And still talking about the PSV 2028, I have a little bit of a challenge with that percentage, 95% financial inclusion target. Because at the end of the day, we have our population rapidly increasing, at a very alarming rate, I must say. So when we set such targets, I think the mindset should be around these are shifting blocks, and we cannot continue to fixate on that, and we should rather have much more strategic milestones we can connect with and then adjust our framework. But which demographic would you say is the hardest to reach when we're looking at this financial goal come the next 2 years?
Okay. So first of all, to the point about how ambitious, 95% is right. So it's about, understanding, learning from experience. We just had one now.
Yes.
When recapitalization was announced some 2 years ago, thereabout, I mean, there was apprehension, right? Some felt this was too ambitious. This couldn't be done. And in some sense, we wouldn't dismiss those skepticisms in its entirety. But I think the job of the leader and the regulator is to, set the goal, provide the necessary support, create that environment that will enable the players to achieve, those milestones. And so that's about the target. So yes, 95% might appear ambitious, but I believe, and the Central Bank of Nigeria believes that it's doable. And it's not going to be about regulators doing it alone. It's about all the actors, including the people that you just spoke to, or that just had the last conversation. The fintechs, the telcos, conventional banks, everybody working together, that's the only
it's all about collaboration.
It's all about collaboration.
Yes.
Thank you.
Yes.
That's the way we can achieve that. And then to the demographic that you might consider at the greatest risk of, maybe being excluded or remaining excluded. Definitely, the youth population is not there. It's not in that, because technology has really helped to bring those into the mainstream of not just finance, but of course of communication as well. So you would then be looking at people who are operating deep in the formal economy. And I like the point made by one of the panelists about the individual who is probably doing some small business, frying akara there, taking some sort of credit, and demonstrated over time, commitment to repayment, but whose data is not available, right? And because the data of that individual is not available, is not visible to the formal financial system, and so such an individual might be excluded, unfortunately, right? So in part, what we like to see is a situation where these companies that are coming up, the fintechs, that with all of the innovations that they have, should be able to bring on board such ones that ordinarily, would have been excluded.
Interesting. Now, we also need to touch on the role of digital identity, and then when we introduce the nexus of artificial intelligence, that also adds another layer to the task ahead. Let's talk about the biggest impact you think AI would also add to this journey ahead.
So AI, it was interesting when some concerns or question was raised by one of someone from the audience about AI. And I like the response that was provided. You see, the interesting thing about AI is this. AI is some kind of, system trained with certain algorithms, that are informed by data. Now, whether you're looking at artificial intelligence or natural intelligence, they all ride on data. So if the data is not there, or if the system has not been trained by the data, then of course it can't be smarter than what it does not know. Right? Yes. So that's a clear limitation. And that is where the issue of us working together, ensuring that data is available, data is shared, and all of that, comes in to help make even AI itself a better tool in our hands. It's not going to go away. It's here. And it's the future. But we have to also understand its limitations and navigate around those limitations so that we can make the most beneficial use of this technology to make our customer experience better.
So then this leads me to my next question naturally, because then we'll be asking ourselves, what is the Apex Bank now doing to balance innovation with responsible AI governance?
Oh, fine. So it's very clear from the tone at the very top of the institution that we recognize AI as a tool that potentially promotes efficiency and effectiveness. And we also subscribe to the idea of responsible use of AI, right? We subscribe to the idea of open banking, open data, and all of those things that can even make it better. Ultimately, see, inclusion is what we think is the way to make the society better. And so we will continue to encourage and, put in place structures that enables operators to be more inclusive in design of products and, of course, in the way they actually go out to disseminate or to implement those products.
Okay. Interesting. We're gradually wrapping up the conversation at this point in time, but I'd like to have the perspective of the Apex Bank now when we are looking at the near-term outlook for Nigeria's fintech ecosystem, and then how we also see the positioning of our fintech here, the thinking going beyond Nigeria, the bigger picture around leading the African charge. What sort of outlook do you think lies ahead, looking at the opportunities and challenges that still abound for the year 2026?
All right, thank you. See, maybe to think about the challenges first, right? Because that's the more difficult part. We are in a world that in which shocks have become more frequent and more persistent. And as the world becomes more and more integrated, you find that, something drops somewhere in China and it reverberates somewhere in Nigeria. It didn't used to be like that. So it's important for the fintech and other operators in this economy to understand that interconnectivity, the interconnectedness of economies, of activities, and of the what do you call now, the spillovers that we get from shocks that have become more frequent. and anticipate that as they design and then move on to deploy. Now, opportunities. The opportunities, tremendous. From population, and of course very active population, to markets, right? Because you're looking at, take Nigeria as a case in point, as we want to speak to around fintechs.
Yeah.
You're looking at a population of over 200, million, and it's going on. So potentially you see that, the market is here. And beyond Nigeria, if you look at the projections, by 2050, thereabout, right? Africa will be about 1/4 of global population, or even more than that. So it means that if you have a good foothold in Nigeria, right, that makes the rest of Africa, almost immediately available to you.
Yes.
And of course, by extension, the rest of the world. So I see, or we see, an outlook that is brilliant, but of course not blind to the possibilities that, as we move on, there might be challenges, there might be shocks, and those have become a regular, pattern, judging from what has happened in the last 10 years. And so us being conscious, these institutions being conscious of those possibilities and being strategic in terms of the way they design, deploy, and also manage, customer experience, will ultimately help in ensuring sustainability.
Yes. Central to all of this conversation is trust and also the element of customer experience. That's the value that gives other currencies more value. Thank you so much for your time. It's been a pleasure speaking with you. We've had a fireside chat with the Director of Statistics at the Central Bank of Nigeria, Mr. Usman Okpanachi. It's really a pleasure to have you here with us today. Thank you so much for your time. A warm round of applause for Mr. Okpanachi. Thank you so much, sir. Just a quick picture, please, before you go. Media team. Now, it's been an interesting day so far. I know we had quite the early start to today's conversations, but I believe we are already taking a cue or two from today's conversations. So thank you so much. It's now time to gradually move on to the next line of conversations. And I definitely promise you that what comes next is even much more satisfying. Now, they say the biggest opportunities often lie hidden in plain sight. Now, when we look at some of these sort of analogies, we talk about oil, for example, that's been with us for decades. This is not what I'm talking about. We look at renewable energy. We've been sitting on that as well. I'm not talking about that. We've looked at telecoms and the sort of disruptions we've had there. I'm not talking about that. I'm talking about our pillar point here today, financial inclusion. Now, for years, we've measured success by asking one question: how many people have bank accounts? And that's one of the thematic areas that also have featured in today's conversation. But perhaps we might have been asking the wrong question. So I think we should now begin to revise our strategy, because at the end of the day, owning a bank account doesn't build wealth. I know that for certain. And then when we look at a debit card as well, that does not create prosperity in any shape, form, or manner. And downloading apps really does not translate to economic opportunity or guarantee economic opportunity. So now the real question is, how do we then transfer or transform the current banked millions of Nigerians to becoming credit worthy? Very important question there now, because when people become visible through data, formalized through economic activities, and trusted through, should I say, financial history, then something really remarkable happens. So today's discussion is not just about financial inclusion as charity. No, it's as a strategy. It's about data. It's about technology. It's about policy, infrastructure, and one of the big key themes, interoperability, and the partnerships we need to unlock the next chapter of productivity at scale here in Nigeria and also the wider African markets. Can fintechs, banks, and regulators work together to reach the last mile? I think we can say, oh yes. Can alternative data become much more central and the new collateral? Yes, I think so. And can we also lend responsibly to millions of Nigerians who have never had access to formal credit? Yes, I think so. And perhaps, possibly, the biggest question, who will own the next decade of financial services in Nigeria and Africa as a whole? Now, to help me answer these pertinent questions, which I've already said yes to, I'm being joined by an exceptional panel representing every critical part of Nigeria's financial ecosystem, from regulation to policy to traditional banking, fintech innovation, financial inclusion, research, and digital credit, the whole 9 yards. Please join me in welcoming our panelists. Look onto the screen as we welcome them.
Chukwuma Nwanze, Managing Director and CEO of Credit Direct Limited. Foyinsolami Akinjayeju, CEO Efina. Babatunde Olofin, Managing Director, Money Points. Hakim Mohammed, Executive Director, Global Markets and Institutional Banking at FSDH Merchant Bank. Moderated by David Alabi.
Thank you so much, ladies and gentlemen, for your salami. I like the fact that you're wearing yellow as well, the bold color in the midst of the masculinity. I love it. I love it. Thank you so much, ladies and gentlemen, for joining us on today's conversation. It's important we look at the next chapter and why this is important, a defining moment for Nigeria as we talk about the future of banking and financial inclusion. Like I said, it goes beyond just the bank account. So Chukwuma, let's start with you now. I would want to know the Credit Direct story and how the strategy has unfolded over the last few years when we are talking about that question of measuring right or wrong, looking at Nigeria's financial inclusion story. Are we asking the right questions? Are we measuring right? Have our successes been limited to just number of bank accounts rather than credit expansion?
Yeah, and thanks for that question. I think about it this way. From where we were coming from, I think it was important that the financial inclusion story brought people into the financial ecosystem, and at the time it was conceptualized, having a bank account was important. As we think about building an economy for the future, then I think we need to move away from the philosophy of owning just the bank account to what financial services truly aid economic development. At the back of my mind and for what I do every day, I've seen how credit can change that narrative from just having a bank account to being a tool or being a resource that helps in economic development and wealth creation. So yes, the question that is being asked, it's not enough to measure inclusion solely by bank accounts. We should start measuring by what it helps to with the ultimate aim of economic inclusion, yes, which allows for wealth creation for individuals and businesses.
Yes. For Salami, I think we would then come to the concept of value when we are looking at the next $100 billion economic opportunity. What does that picture look like for you? Where will that value actually come from when we're taking some cues from Chukwuma's point of view, where we've always calculated based on accounts? Kindly share your microphone, please.
Thank you so much. And good morning, everyone. Lovely to be here. Let me just quickly piggyback first on what he said. And he made a valid point which is when we started to measure financial inclusion, this is as far back as 2008, let's picture what financial inclusion really means first. It means at the time in 2008 when the first access to financial services in Nigeria survey was conducted, led by Afina, it meant for every 10 people, at least 7 were out of the financial system back then, in 2008 thereabout. As of today, well, the latest figures we have is the 2023 figures. I'm able to say before the end of the year, we'll have more, recent figures. We'll be able to now compare how much progress we've made since 2023. But 2023 we have the latest figures from 2023. We've seen a massive shift in financial inclusion, particularly in people using payments, digital payments enabled by the non-bank, the fintechs mostly. Now that figure has changed from about 7 people out of the financial system to just about 3. I'm not saying we're there yet, but we've made tremendous progress. So yes, access is the foundation, but access alone, like you said at the beginning, does not guarantee productivity. It does not guarantee that you'll be resilient. In fact, in the period where we saw financial inclusion increase to 74%, that same period we saw financial health decline. What does financial health mean? Ability to save, to raise emergency funds, to be able to, withstand shocks, to bounce back from shocks when shocks happen. So we're seeing access improve, but financial health decline. Why is that? That's because for many people, they are not using financial services meaningfully in a way that enables them to improve their lives or their livelihoods. So the question should no longer be access. Access still remains a challenge, at least as of the latest figures, 26%. But it's now sustained use of a broad range of financial services. Credit being one of them, insurance, investments, pension, the broad range, such that when people are facing economic or climate or health shocks, they have recourse, such that people can save for productive, investments, such that people can use credit to expand their businesses. That really is the promise of financial inclusion. So back to your question, where will the next 100 billion come from? So, I talked about those who are, excluded, and also those who are included, but just, at a shallow level. I believe that the next 100 billion already is here. But how are we going to unlock that? It is, and I think a lot of people have referred to it. People are already engaging in economic activity, but they are invisible, they are not trusted, they are not seen as investable. So really, we need to unlock their economic identity. We have over 120 million NIN, digital identity. But how much economic identity do we have? So we need to make economic identity visible. All the money, mobile money transactions, all the digital payments, all the supply chain interactions, the value chain participation, all of that needs to become visible. That, of course, can be enabled by technology, but then it has to be, of course, grounded in consent-based sharing, interoperability, governed by customer protection frameworks. But more importantly, so that people can use this to be able to make the case for I am investable, I am bankable, I am trusted, so that all those financial services that eluded them to date can now be available to them.
Yes. Thank you so much for your Salami. Now, coming to you, Ezekiel, let's talk about the Money Point story now and how you would describe value, also taking cues from Salami's point of view here, because we've also seen Money Point become one of Nigeria's biggest success stories when we are looking at businesses and households, individuals accessing credit, banks and payment solutions. But would you say as fintech effectively become the new infrastructure, retail banking infrastructure, and whether or not our traditional banking still remain indispensable?
Thank you very much for that question. First, I will not say the fintechs are replacing the banks. Neither will I say it is the fintech versus the banks. It's actually the fintech and the bank. what we have seen so far is an evolution in the financial infrastructure across Nigeria. We have seen that, and that is given. But individuals and these institutions, including the banks and the fintech, they are contributing in their own distinct way to the financial ecosystem in Nigeria. Take the traditional banks, for example. They are indispensable. And why do I say so? They provide deep capital.
Yeah.
That is given. And apart from that, they also provide this stability within the financial sector. And apart from providing stability, the traditional banks too, they are also responsible for institutional banking. Having said that, the fintech, for example, they are also essential, especially when it comes to everyday commerce.
Yeah.
Today, people are experiencing banking in a different way. To some individuals, the first way they experience banking is through the POS. Not just through the POS, the mobile banking or the mobile application on their phones, the USSD, without internet, the agent network across the country. These people are experiencing banking through this mix today. So this makes us to know that yes, the fintech are essential for the everyday commerce. Take Money Point, for example. We provide support to over 20 million account holders, both individuals and businesses. And these people, they are across the 774 local governments of Nigeria. They are accessing the platform using USSD with or without internet. They have access to the banking agent. So the major thing is not actually the fintech replacing the traditional banks or the fintech versus the traditional banks. It's actually more of collaboration.
It's synergy.
Yes, it's actually more of collaboration. And that is what we have seen. And the future is actually for institutions that will be able to take advantage of the strengths that both the fintech provides and that the technology from, the deep financial capitals from the banks. And once they're able to take advantage of this to provide the required best customer experience and bringing about this collaboration, that is actually the future we are looking at.
Whoever provides the best value wins their trust, I think.
Definitely.
Well, Hakeem, now it's interesting to bring this question to you from the point of view of traditional banks and FSDH being a merchant bank. But I'm quite interested in also knowing now the thinking of FSDH when we talk about boots on the ground in an ever increasingly, should I say, fast-changing digital banking landscape. What does that mean from an FSDH perspective, and what does the future look like? How are you revising your strategy going forward to ensure you're top of game?
Okay, thanks. Thanks for the question, and good morning, everyone. So, as a merchant bank, we don't even have the luxury of these plenty branches, right? And what it then means is that we also have to then look at both the physical side of things and the digital aspects. And for us, we see it as being complementary, but it has to be sequenced in a particular way. I think probably one of the most consequential policies out of the central bank, maybe in the last decade or so, was the introduction of BVN. What that has done is that it has helped a lot of these fintechs, to leapfrog. So things about customer onboarding and getting KYC done became easier because you then have that identity, identity foundation that you can just build whatever you want to build on, right? But having said that, it still doesn't mean that, that human touch, can be missing. But one of the things that also, maybe also out of the central bank, is the agency banking and the open banking, initiatives that have been pushed in the last few years. What that has done for banks like us is that we're able to leverage on agents that have been deployed by some of these fintechs to help us get to places that we ordinarily would not be able to get to. Because for us, and if you think about even for some of the retail banks, a lot of them are actually reducing in terms of branch expansion, because it's no longer important,
profitable.
right? Gone are the days when if you needed to do any transaction, you had to show up at the bank, right? Money Points, OPay, and all these platforms have shown us that you can do all of these things on the mobile app. And that's why you see also even the traditional banks all have like internet banking platforms that they use to provide services to customers. So boots on the ground, yes, still relevant, but not so relevant anymore, because once you have the digital rail, the way you can build different things on, you can still reach the customer.
Yes, it's all about pivoting. Kindly pass the microphone. Okay, we have one here for Chukuma. And then when we now look at the next picture as well, in the fast-changing ecosystem we have here, can data replace collateral? I'm quick to look at the scenario of Ghana, where we have very strong mobile money transactions. We are looking at utility payments also being an important feature in what shows who the customer is. Do you think we can really leverage on that, or are we overestimating the power of alternative data where we think about what should be the next step around data and serving as the next collateral?
All right, thanks for that question. If you think of the philosophy that came about financial institutions requiring collateral, it was to give some sort of a comfort to the financial institution that you have the capacity to repay back as and when due. It was really looking for a behavioral proclivity to who you were lending to. And if you look at what data is doing today, it's just a better form of what traditional collaterals would be. I mean, so in the past, the bank will say to you, bring a tangible asset that is 1.5x, right, the value of the loan you were taking. Today, we are looking at behavioral data. I mean, the great work that has happened in the last decade around payment infrastructure, the technology proliferation has made a large chunk of data available per individual, right? So today, even for guys at the base of the pyramid, guys who are not below the underserved part of the value chain, you still have some sort of data points on them. So I can almost tell a story of an individual from the different data points. I'll use what I do today, for example. So if I want to give credit to a person, beyond what I can get from the credit bureaus, I can make a lot of sense from what I see from your banking transactions. There's also the little matter of data from what's happening in the telecommunications ecosystem. So what we're seeing every day is that as technology gains ground, I'm knowing a bit more about you. And so I can use that behavioral data as a surrogate for the collateral of the past. Now, that said, it's still a long way to go. I mean, central bank has put certain things in place to ensure that every individual's, say, credit activity is reported on a monthly basis. We have those kind of information. Payment entities like MoneyPoint have done their own bit in ensuring payment infrastructure is available. EFINA keeps on talking about financial inclusion. But you see, at the end of the day, there's still that bit where the end user has to come to an understanding that everything I do has a digital footprint or a data footprint that can be used in determining. I mean, we talked about earlier on how we have to move from account-based financial inclusion to what is more value-driven, and we think credit, insurance, and risk can do that. For that to truly happen, then individuals, there has to be the reorientation that your digital footprint or your data points are as important as your ability to build wealth for the future. So yes, tangible collaterals can't exist. And if you think about it, we're in a very fast-paced world today. I mean, on the average, it takes 120 seconds in my organization for us to make a decision on a person. I'm not going to ask you for a car. I don't want to. I'm not a motor vehicle company, right? But I have enough. And one may say that, oh, what are your MPLs like? Yes. I can tell, and I can tell you that every day is getting better. We are seeing better asset quality. And I think what is even more important, people say, oh, well, consumer credit is a bit expensive. The better the quality of data, the better the decisioning, the lower the loan loss provisions or the cost of risk, the easier it is for financial institutions to make credit affordable, and then the closer we are to achieving economic wealth, which I think credit provides a solid foundation for.
Interesting. Now, for Salami, let's talk about EFINA now. EFINA has also been the bedrock of, should I say, data and truth when we're looking at financial inclusion. But in the last few years, understanding Nigeria has many layers, nuances when we're looking at our current structure here. Walk me through some of the interesting insights you could possibly share, and then what are some of the missing elements or the ignored trends or data we still have our policymakers, infrastructure providers not really pay attention to?
That's a very important question, but let me put a caveat out first. You know, I said earlier that the latest data we have is as of 2023. Be on the lookout. By the end of this year latest, we're going to have more recent data, so we'll be able to make reference to that. So my responses will be based on the 2023 data. And that's because without data, you're just another person with an opinion. So my opinion, forgive me, is based on maybe what you would call dated data. But to the point you made, and I'll just emphasize a couple of things, right? So there is still the emphasis on access. Those headline numbers, Nigeria is at 74%, and now we're targeting 95%. That's great. But when you break it down, 2023 data tells us that things like pension, insurance, investments, credit were all under 10%. And I'm being very, what's the word now? Optimistic. I don't want to say it as it is. And that's just because we're expecting, new data. So under 10%, the things that enable resilience, the things that enable health, the things that would make the people that call you every day to say, urgent 2K, those things that really matter, we are not focusing on them enough. That's number one. Number two, we see that in spite of the progress on inclusion, there's concentration of exclusion among certain segments. Women, rural populations, northern populations, the informal sector, people living with disabilities. The concentration of exclusion is within the segments. So if you're looking for a place to focus time and attention, and I'm not saying that you don't have exclusion among other segments, but if you're looking for where to spend your time and resources and attention, is on the segments. Another thing is trust. We focus on, so let's build new products, new apps, all of these things. But trust is a fundamental ingredient and is the currency in the financial system, no pun intended. Because without trust, and people are justifiably unsure. We're having issues of fraud. Even if the incidence is on the decline, the impact when they happen is severe. Hidden charges remain a concern. Yes. Also, the customer experience, how people feel, how we leave them feeling after interactions, the long waiting time to resolve issues, the fact that their digital literacy or financial literacy levels are not accommodated in the products, those things still leave, a bitter taste in the mouth of the people. So if we're looking for what trends to focus on, it shouldn't be as much on financial access, rather it should be on the financial impact that we can make by focusing on these trends that I've talked about.
Interesting. Now, Ezekiel, we also have a huge resource of data when we're looking at our POS transactions, the trends there. You look at inventory purchases. All of these generate data. You also have the likes of the NINs, TINs, BVN. It's just data upon data on different levels. But when we look at the nature of the Nigerian economy, some of the stress points we have for households, businesses, especially SMEs, MSMEs, why do we still consider them as high risk despite having this big pool of information whereby we could literally track anyone who is under the radar?
Having data is not as same thing as having actionable insights. It is possible for a business to have thousands of digital payments, but the lender still need insights. The lender wants to understand whether this business cash flow is consistent. The lender wants to understand if the business has the capacity to repay. The lender wants to understand if the business is stable. So all of this information can only be understandable when the lender looked at the data beyond just the data. So it needs to be able to decide that this data I have, I'm able to make this informed decision with this data before borrowing to the
So what do you
business.
expect MSMEs to do now to ensure that they have access to the much needed credits to scale?
So what we have done at MoneyPoint, right? MoneyPoint, we give payment infrastructures to these MSMEs. And once MSMEs start collecting digital payments, it gives them this financial identity. And with financial identity, lenders are able to take decisions with this data that comes from this financial transaction. And we have actually done that in a very large way and at scale at MoneyPoint. We have over ₦1 trillion as credit that have been given to MSMEs. And this was given in our last year reports. And this is possible because we just look beyond just the data. We were able to make decisions with the data. We were able to understand that these businesses, no matter how small they are, even though if they are at risk, they are businesses that are sustainable, they are businesses that have consistent cash flow, and they are businesses that the individuals that are managing them have credibility. With this decision, we're able to lend to them. Ordinarily, the traditional way of lending, we overlook these businesses. So data alone is not enough, but when you look beyond this formal data, we are able to make an informed decision and lend to these businesses in a way that will minimize risk.
Okay. And talking about risk as well now, let's take the conversation to the last mile. Hakeem, looking at our rural areas and the dynamics we have changing when we're examining the economics of rural lending and risk management. How is this changing data also introducing fresh nuances and the sort of opportunities this would likely open up from a merchant bank like yourself?
Okay, so I think, since we're living in the future now, I can start talking in the future.
Next 5-10 years.
Yeah. So jokes aside, but I think data is the new collateral. Because if you think about the amount of data that these guys are generating, on a daily basis, with mobile banking, with POS transactions, with even telco data, we're generating enormous data, and I think the future, will belong to players who are able to process that data and get things out of it. So if you think about the rural dwellers, what's the issue? So you have let's say a farmer in Makurdi that produces mango, right? The guy is structured in a way. So he has maybe some off-taker, somebody that comes to buy the mango from him in bulk, right? But the problem we have today with traditional banking is that if that guy shows up tomorrow and says he wants to take a loan, we can't really assess him because, again, it's probably a one-man business. He doesn't have accounts. Maybe sometimes he's even paid in cash. But the truth is, he has an arrangement with someone whereby he knows that once I produce, this guy is going to come and take this from me. And that buyer is actually a credit-worthy person. But the problem with what we have today is that you are not able to link it. Therefore, the future will really belong to people like those, right? Institutions like, maybe MoneyPoint, and similar entities who are working with people like this, trying to see how they support them. So, for example, there are risk-sharing structures that can be brought into place. So if you have an off-taker and you have some domiciliation agreement between the mango producer and the and the financial services provider, then that way you are sure that this payment is going to come. So extending credit to that kind of individual will not be an issue. Because the issue with the traditional way of assessing credit is that we look at things like financials, we want to see your payment history, and all of that. Those histories exist today, but just that they don't exist in the way we are used to. Right? So it's the institutions of the future are those that will be able to look for this data and process them in a way that still enables us to extend credit to those rural dwellers. Those will be the guys that will win in the future.
Yes. And I'll still come back to you, because when we also look at the ecosystem from the perspective of a merchant bank now, with the big picture of the African continental free trade area, it looks quite interesting. But we are yet to have that pool of MSMEs from Nigeria play as big boys and big businesses. Let's talk about going beyond providing letters of credit and also working capital. How is FSDH, for example, also re-strategizing to ensure that our MSMEs become export ready to tap these sort of big opportunities? Because we've barely scratched the surface.
Yeah, absolutely. And one of the things that the Africa Continental Free Trade Agreement, what it gives to us, is really access to markets. So the demand side is sort of sorted. However, on the MSME side, and that's why at FSDH we do have a business banking unit who caters more for SMEs. And one of the things that we do a lot in trying to get our customers like export ready is around capacity building. For you to be, by the time you are issuing LCs and getting maybe working capital from a bank, to a large extent, you are no longer MSME. You already have something that is working. The typical SMEs or MSMEs do not have, annual accounts. Their products producing, but under this, by their standards, their certification standards that need to be met, right? They may not be at that level yet. So one of the things that we are doing, working with our team and some of our development partners, is to actually build capacity for some of these guys around how do you get them to, as you are producing, know that, you need to get some certification, you need to get these other certifications, so that whatever product that you are producing is export ready, is market ready. And you are not going to be, left out in a situation where, you have the products, but you can't export because the products may not be suitable for the market you are trying to export to. So I think those are the things that we need to do. And collaboration with, like I mentioned, maybe SMEDAN, export agencies, even banks, fintechs, who are already reaching some of these guys. Those are the things that need to be done to be able to prepare some of these clients, our SMEs, for the export markets.
It takes a whole lot of hand-holding to ensure that we are able to reach the goal, and teamwork makes the dream work. So, for Insolami, let's come to you now. Once again, because at the end of the day, your team is quite resourceful with data. But when we look at an issue you raised, tailoring our financial products right, would you say we're still building around institutions rather than people, actual lives? Because there is still that element of profitability hovering around the sort of products we have in the markets, wouldn't you say?
I think that's a fair comment to make. A lot of progress has been made. I mean, with the likes of Credit Direct telling us that they're taking decisions in 120 seconds. That's 2 minutes. But I think it goes beyond speed and convenience. I think far too many times we see organizations build products around their own processes, around their own convenience, and expecting the customers to fit their lives to those products. It doesn't work that way. Especially, let's go back to the segments that I said are underserved, right? Take a woman, maybe a woman trader in, I think it's in Maiduguri or Farmer. This woman, besides the fact that she needs to deal with seasonal income cycles, she has household responsibilities. She has times she cannot go out. She has, digital or even financial literacy, constraints. Inclusion is about empathy. So if we're building products and services, we should be building it around what the lived realities of our people. Progress is ongoing, but I think there's still some ways to go. So what I would say is really, even going back to, if you're trying to be profitable, You need to expand your customer base and not just focus on fighting for the same market share. If you're going to expand your market, you need to consider solutions that fit the needs, the lived realities of that excluded market.
And some of the lived realities we also have is the growing global trend of buy now, pay later. Chukwuma, let's talk about that now and how we are seeing embedded credit also become the new gateway as we look ahead.
Yeah, I think, I like to think of embedded credit as people getting access to financial services at the points where they do life, right? So whether it's in a supermarket, whether it's in your child's school, right? And I think that for me is people not coming to financial institutions, financial services or financial products, meeting people where they do life. And it's unbelievable what we see at Credit. In fact, if I think of our origination products that bring the largest chunk of customers, is customers who have buy now, pay later needs. And I think it's done a whole lot for us as a business. But that said, for embedded credit to scale, right, and I touch on this again, for embedded credit to scale, a lot of things we've talked about here become important. One, the infrastructure has to keep improving. Secondly, identity has to improve. And people have to be mindful about that. And finally, financial institutions have to come alive to the reality that the world is changing. The world is very fast-paced, and people need to make decisions on the spot. And once we can put financial products or services on the spot where people need to do life, then we will see a scale. It's important for us to note that if we look at the context, if you look at Nigeria's credit to GDP, is somewhere around 13-14%. If you look at it in South Africa, it's not of 100%. If you look at it in developed economies, it's not of 100%. And it just tells you how far behind.
I like the fact that you introduced this point when we're looking at our continental pairs, because at the end of the day, we are all quick to mention scenarios around global fragilities, uncertainty, inflation being sticky. So what sort of cues should we take from this sort of economies and then replicate here, irrespective of the headwinds we have?
I think it's important, right? And central bank is doing some things. There's a conversation around open banking, right? It's a conversation because it's not yet fully implemented. If you look at the economies that have achieved high credit to GDP ratios, you will find out that open banking is prevalent, where data sharing within the right frameworks is encouraged. We've solved to a large extent the identity issue with BVN and NIN. And again, another point is we also have to come to terms with the economic reality of Nigerians. I was speaking to a banking CEO one time, and she said to me that we have over 5 million customers, but we have less than 60,000 of those guys who have steady balances of not over 100,000. So yes, many a times we want to take credit decisions, but the reality is that the disposable income is really not there. Yes. We look at the top line. Your net disposable income makes it impossible for you to meet your requirements. So there's still some work to be done, but the gap is immense. And from the regulators, the traditional financial institutions, advocacy bodies, development financial partners, fintechs, everyone has to come together to solve it, because the government talks about the desire to have a $1 trillion dollar GDP. I see it as nearly very possible, right? But work needs to come together. Progress has been made in the last decade, but some work needs to be done over the next decade for us to get there.
Okay. And then this naturally brings me to you for Insolami, when we're looking at the fact that we are sitting on $1 trillion economy already, looking at our informal economy. But why do millions of entrepreneurs still, should I say, box themselves, or the societal structure, the economic structure, boxes our entrepreneurs still to remain in that informal sector? The incentives are there to pivot, but would you say formalization is attractive enough? I think that's where I'm going.
I don't want you to put me on the spot that way. I'll say this way. Formalization doesn't happen because the government says so, right? It has to be worthwhile. It has to be value-adding to any rational human being. Entrepreneurs nevertheless. So if formalization is only about additional paperwork, or now you're just exposed to tax, and you have compliance requirements, but there's no commensurate value. Like we've been talking about financial identity all day long. We've been talking about access to affordable credit all day long. If it doesn't connect to benefits of like such or even more, there's no real incentive to formalize, because, again, there is a burden for formalization. But I think the question we should even ask is, what are the alternatives? I'll use the word surrogate to formalization. I'll go back to is identity, financial identity. So, for example, if we allow things like your warehouse receipts, someone talked about, tracking your transaction across your value chain, across your supply chain, and that data is available for all those things we've mentioned, like benefits, then there's a natural inclination to want to formalize. If we're talking about taking advantage of the benefits of AFTA, there is an attraction for formalization, but otherwise, it's just another burden. So really, I'll say maybe let me add a solution to it. The solution, therefore, should be, if we're going to summarize it, is digital public infrastructure, right? Open banking is great, and the guidelines exist, and progress is, ongoing along those lines. There are a few, tweaks that need to be, closed. But I'll say it goes beyond open banking. It should be open finance, such that outside of the banking space, data coming from all these other sources can be, plugged into that. And then now plugging that DPI, digital public infrastructure, into the real sector, into the agriculture value chain, into the MSME space, such that you can track all of the data, all of the transactions, all of the receipts, all of that, and use that to make the case for those benefits we're talking about. Then formalization just happens naturally. Then they have access to government services. You don't have to. And now we're seeing it for some of us that are, the elites. We can sit in the comfort of our, homes. We are doing, passport application. Good luck to you if you try it that way. But bottom line is, we're doing all of that. If this nano, micro, small enterprises also have those kind of benefits, formalization will happen naturally.
And then, Ezekiel, definitely payment is a gateway into formalization. I'm sure that's what you're going to tell me next. But can you eventually provide loans, or should I say tax records and insurance, bookkeeping, inventory management to these sort of businesses without them even realizing that they're already formalizing themselves?
Absolutely. That is it. As you already mentioned, payment is the beginning of the journey. Right? When payment is enabled and we have data on digital payments, formalization follows. Today, people will not formalize, just as you have said, because government asks them to do so. It cannot be enforced. It can only be enabled. And payments is the easiest way to enable this. When the MSMEs, when they have an easy way of collecting payments, this gives them the required financial identity. And this makes room for lenders to easily access them from credit. It makes room for lenders to offer them loans. And this also provides the required support for tax. So, yes, payment is actually the beginning.
Okay. And Hakeem, when we are talking about trust-driven formalization, let's also look at the scope of recommendations now to the authorities, the policymakers here. What would that one recommendation be?
Okay, I think it's to design, that recommendation will be around designing policies around data portability, because like I mentioned earlier, we're generating a lot of data, either it's mobile money, these POS agents, etc. And people are making payments. The informal sector, they are making payments or receiving payments that we may not be aware of. But setting up a framework that allows data sharing within the sector would help a great deal in helping us achieve the next level of what we're trying to achieve.
Well, we'll be back again come next year and the next 5 years to assess ourselves on how well we've done. Thank you so much, ladies and gentlemen. It's been a pleasure speaking with you. A warm round of applause, please. A quick picture, media team. Thank you once again.
Thank you, David. Very, very, very interesting conversation. I look forward to this networking break that we are going to segue to in a moment, so I can catch some of the speakers, because I thought that was very, very, very insightful. I like the theme about the inclusion alpha, because it's not just about inclusion. Inclusion, of course, is very important, but there is a return that can be made from that process. So I'm hoping that the insights that we've shared today has opened our eyes to what's possible. And one thing that I'm very happy to hear is that we have way more people watching and joining us virtually than we have in the room. So this message is going far and wide. Just before we take this short networking break, I just have to announce a couple of things. The first thing is that, first of all, right after the networking break, we are going to have our last panel, and we're going to wrap up the event. That last panel I don't think you want to miss, because we're going to be unpacking some very important conversations around efficiency, building the credibility and the technology to make all that we've discussed work for everyone. And so we'll be having that right after the break. The break is just for about 20, 30 minutes. We're already into that time. The other point I wanted to make is that after the last panel, we are going to be having lunch. Lunch will be served in a restaurant. I'll be providing some more information on that after the break. And your ticket essentially is your lanyard, so make sure you are registered if you would like to participate and join us for lunch. I also have to mention the hashtag. So for everyone watching online and also in the room, please use the hashtag FOBNigeria as you share your thoughts, your pictures, your comments on social media. Thank you so much for that. We want to really appreciate all our sponsors for making today's event possible. We have been rolling their logos on the screen. Thank you so much for your partnership. And so on that note, I'd like us to now connect again as we take this short networking break. We are scheduled to be back here at 12:30, which is just in a few minutes. But please meet a couple of people. At about 12:25 or so, we'll try to be calling you back into the room. Coffee is served at the back there, so please refresh yourself, and we'll be back to continue with the conversation at 12:30. Thank you very much. How are you, sir? get back in the room. Please take your seats if you can. Oh, he's here. Right. I think he's taking a meeting though. Okay. All right. Maybe later. All right. Okay. Ladies and gentlemen, please take your seats if you can, please. What is this? Let me have one. Thank you. I should take it though, but I'm busy now. Ladies and gentlemen, please take your seats. Thank you very much. Please, can we come back into the room? Thank you very much. The prof.
Actually wanted to say anything.
So we can stay on schedule by taking your seats now. We are about to get started with the last panel before lunch. Welcome back, ladies and gentlemen. If you can, please take your seats. We're about to start the last panel session. Of course, the focus this time is the efficiency frontier, AI, RegTech, and cyber resilience. So far today we have talked about the customer, we've talked about inclusion and the alpha around that. Now we want to speak about, if you like, the rails, the base that makes all this work. So everything from artificial intelligence to regulation and, of course, cyber security. Can't run away from, because in the new era of technology, it's not only about being able to offer a service or product, is to ensure that that can be done safely from the perspective of the user and the provider of that service. And then, of course, the resilience around that forms that underlines all of that in terms of the systems. We're going to unpack that a little bit to learn quite some on that theme. So I'd like to now turn your attention to the screens as we get started. And as you find out who our speakers are, I'll encourage them to come to the stage so that we can get this conversation started. I am sure as we get started, more and more people will flow into the room. So please, can we roll the video?
Ayotunde Koka, CEO, WIOCC Nigeria and Open Access Data Centers.
Please put your hands together for them as they come.
Kashifu Inuwa Abdullahi, the Director General, CEO at NITDA. Professor Yinka David West, Dean, Lagos Business School.
Pleasure to have you, sir.
Femi Oshinubi, Africa Advisory Leader at PwC. Moderated by Wole Famurewa.
Many thanks to my panelists. Thank you so much, PwC, for being part of this. I can assure you, you're going to learn a lot. And I'm going to try and simplify things as I ask Dr. Koka to open things up for us. Because I think there is the tendency for people not to really appreciate the importance of this conversation that we're having now. So the banks have raised capital. They're expanding their services. We've talked about the digital-first platforms. Everyone is out there trying to provide a service. But why are, in your view, hyperscale data centers like yours critical to supporting real-time AI-driven financial services? And I want to emphasize AI-driven, because I think that's something that gets missed. People simply believe that services are being deployed, but in the AI era, it's not what it was. Please go ahead.
Yes, good afternoon, ladies and gentlemen. Great to be here. Thank you very much. The things have changed so much in the whole world.
Indeed.
The advent of cloud, co-location data centers over the last 25 years or so, you don't have to build yours, you leverage shared facilities. That's the norm now. I get puzzled when I'm speaking to an enterprise that says, I'm going to build a data center. And I'm thinking, really, this day and age? The background is go back 16 years as CIO of Access Bank. And, I asked, before taking on the role, what's the big issue, big challenge, or we need a data center? And I'm thinking, in the UK, you wouldn't build one, you would outsource. I was City of Criminal Justice system in the UK, and I would say, look, spend the money on schools, on roads, on whatever, prisons, and hospitals, stuff like that, and we would outsource. Anyway, I turned up in Lagos, and there was nowhere with a credible, proper data center to outsource to, so we built one.
Right.
Yes. Now, fast forward 15 years, I was running Rack Center from about 12 years ago, And the key thing was to change mindsets. And it was a very tough one. Lots of people feel, I must have my data center. But then you make them to realize that actually it's a core skill set that's very complicated. It's a mixture of mechanical engineering, civil engineering, electrical engineering, and you've got power and all of those things. I remember once my wife saying to me, director of power, right? Because I was worrying, instead of transforming the bank, I was worried about whether I had water in my diesel. Right. I was worrying about whether these generators will run and so on. But now that co-location aspect is now normal, that you would just find a good, credible partner. You have the levels of certifications and everything that shows that there's a certain level of standard of operating. And this typically operates 100% without downtime.
Right.
So you can focus at the front end of your business.
But what is happening at those data centers? Because I did mention the issue about AI. Everything is so fast now.
Exactly.
And I think many people do not appreciate the processing that is happening in the background.
Yeah.
So maybe you can speak to that.
So now what it is you have an environment that has all of the sort of connectivity you need, the power you need, the structures you need, and the processes and the people to ensure that this big sort of building that houses all of these servers operate effectively. 2, you build an interconnect ecosystem where all of the carriers, that you need you'd want to link to is just a connection away. Rather than going to do a deal and you bring your fiber to my bank location and everything, you can just interconnect with these things. You have the internet exchanges that are hosted in those data centers that make it efficient for you to deliver services. We talked about quality of service in payment systems earlier on, right? So you've got these things that are ready-made. It's a bit like, each time you don't want to build your own hotel because you've got a few people who are going to, but you go to find the right standard of hotel and you stay there for, it tends to be a long relationship anyway, right? With cloud providers or enterprises that want to co-locate. But one thing's changed over time. Enterprises also would co-locate, but with their own IT systems.
Right.
Now you have enterprises leveraging cloud systems, internationally or locally. Today, mostly internationally, right? But you also, even if it's international cloud systems, you want an environment that enables you to effectively connect to those cloud systems. But there's been a shift. The CBN just announced that it's mandatory for payment systems to hold their data in Nigeria.
Right.
So that means, therefore, you have the cloud capability and the data centers are in place right now. Now, I'll just paint one scenario. The pace of change is so quick, even within the data centers right now, that you can have a conversation and 6 months down the line, the circumstances have changed and the demands have changed, right? Now, if as a company you need that agility, if you have to constantly think of scaling up to meet that change, by the time you ask for the millions of millions of capex, you take it to your board, they approve it, you do your design, you build it. It takes you 18 months. The world has moved on. The world is moving on in months, not years, okay? So it's critical, therefore, to have the kind of digital infrastructure partner that will enable you to leverage cloud services, your own compute, plus other AI.
Right.
Now, the compute for AI also, to have an AI-ready data center, means also you need to have the capacity for very, very high density per square meter compute.
Right. Before you continue, I think I should just throw in this follow-up question, because I'm staying on you for quite a bit, but I think it's so important, so people better appreciate this. If you can help us describe the relationship between that data infrastructure resilience that we were talking about, things like system uptime, and the return that these banks and others who are raising capital are looking to get from their investments in the service they are offering.
Okay, good. So I've gone through that infrastructure thing and the agility you get, that I'm thinking about this is ready for AI, okay? The use of AI by the banks isn't the fact that they build their own AI. They integrate it into what they do. but they need to integrate it efficiently. So you now have to have an environment where the providers of AI platforms are able to come into with this very complicated, even more complicated, dense environments now. So technically, you'd have, say, air cooling and so on. We make sure that we have the infrastructure that can enable liquid cooling and the kind of buildings that have the right engineering structure in space and in strength, because these are very, very, heavy compute environments.
Right.
Okay, and I have to now go and figure out how I can get 50 megawatts of power in Lagos, for instance. I worry about those things, and that's the value that
you are offering.
Yes.
Right.
Now, if you look at some of the things, when you look at the payment systems, the payment systems vision 28.
Yes.
The CBN talks about collaboration. They talk about reliability, and so on. And the panel also talked about customer experience. Okay, if you don't have the infrastructure here to leverage, you have issues with the latency of having to have systems that sit. So when the CBN was mandating, it's not just about sovereign data, which is the primary reason. You also have the latency, that the distance it travels to that computer is a long way.
Maybe you can illustrate what that latency looks like in real life to the user.
You're on your phone and the thing goes round and round and round.
So that is what is happening.
That's what's happening. Your experience is terrible.
You're trying to make a transfer, it's not going through.
Exactly. So if I'm a fintech and everything just feels a little bit delayed, but another fintech just goes swimmingly. It really feels
That's what's really driving the difference there.
That just defines customer experience, for instance, and your ability to interconnect efficiently, and localize data. You're not chasing data all over the world only to come back to realize it's where you are, right?
Right.
So this kind of integrated infrastructure allows fintechs to operate effectively. Okay. Now, when you also look at collaboration, it's a now subtle thing that the CBN is saying, that you don't do everything yourself. You collaborate.
Right.
And you bring it, therefore it gives you the business agility. Okay? If you had to build your own AI and the backing infrastructure for the AI because you're a fintech, right? You just won't execute quickly enough to meet the competitive environment of delivering more and more functionality out there.
Right.
So we already have AI in our lives, and you talk about agentic AI, so on. That's happening so quickly because a lot of the underlying infrastructure we take, talk about data centers in Lekki and, mainland and other locations. They're bringing in that capability.
Right.
So locally, increasingly. So where AI is going to come in from an infrastructure point of view is you'll hear about these large language models, right? And everybody's talking about why it's going to be in the Nordics because of free cooling and electricity and everything. Because it's not latency sensitive, you can consume it here. And DG will talk about a variety of other things that have been going on with respect to bringing AI into the local context at different levels, at the continental level, at the regional level, and the Nigerian level, and even more locally within the Nigerian level.
Right.
So what do we do with the infrastructure? It means, therefore, we have a capability that can support medium to small language models and contextualize those large language models around here. The next thing that's happening now is, and we're Pan-African, so I'm based in Lagos, but we've got data centers around Africa, South Africa, and so on, and we're expanding beyond that, is the emergence of what they call is sort of the inference layer, is the middle layer, that is now latency sensitive, and it brings compute into what we do. Plus, if you're a fintech, for instance, you need to reach all of the eyeballs. So you have these interconnect ecosystems that allow you to connect to all of those mobile networks and MVNOs and so on to reach your eyeballs. Then, and that compute needs to be efficient and effective. Then you have the front end, which they call the agentic, is called the agentic layer. That agentic layer sits either under the apps within your phones to bring that AI to life, right? And that's starting to happen. Or is some sort of Internet of Things, business-to-business interconnectivity of machine to machine, right? That's using that compute. And now we're now starting these things coming at about 2-3 megawatts ago, right? So the infrastructure that we're enabling is one that allows the kind of AI-ready, cloud-ready capability to make all of this stuff happen seamlessly.
Great. Thank you so much.
It's pretty complicated, but that's
well,
a simple...
I know there's a risk that we are speaking above the heads of some people in the room, but I think the point is very clear that we need these guys. If we're going to play in the AI era, you can't do it by yourself. You've got to work with the data centers. But you may...
I just wanted to add some statistics I've used for some time, and it's important of why it's, if we're going to hit $1 trillion economy, we need the digital infrastructure that will enable it. It is critical country infrastructure, just like we talk about the roads, and so on. And why? You see, in Africa, where it's increased to about 18% of global population, right? We were about 4% of GDP, global GDP. But because our population has been increasing, well, it's changed, thankfully, but it was, more recently. Africa country GDPs are rising. In Nigeria, we're now having a 2% gap between GDP growth and population growth. It used to be less, right? So what's happening, therefore, is we were 4%, we went just be below 4%, but the trajectory shifted back to being more than towards 4% back again of global GDP. But we only have 1% of global data center infrastructure. But the rest of the world is now building quicker than us, right? So we actually went below 1%. So we now need to, it's not about adding more, 50% more investment. We need to double, triple to catch up with the world. And you see, we need to close that digital gap, right? If we're going, the 18% to the 4% of GDP is what I call the prosperity gap. So if we're going to close that prosperity gap, we need it through digital infrastructure gap to bring in the AI and everything else that we require to make us more competitive economies.
Thank you very much. A lot has been said on this point, and I want to take it now to the DG to hear his perspective, because he mentioned agentic AI, and essentially that's where you automate systems to execute transactions, make things like credit choices, all autonomously. And he has made the point as to why that computing power is what really enables all of that. But the regulatory frameworks also are important for this to work. So I wanted you to speak to that. How, because he has already flagged an area where potentially we can make such a huge difference in terms of the local experience of the AI, the LLMs, and so forth. But the regulatory framework also needs to be in place. Can you just speak to this point?
Okay, thank you very much.
Can you turn it on? No, turn it on. I'm sure it works. Yes. Yes, go ahead.
Okay, thank you very much. Let me just reiterate what Dr. Kuka just mentioned about that Nigerian banking sector has demonstrated a remarkable resilience from the banking consolidation of 2005 through the post-2009 reforms to the current recapitalization. We've seen how the banks, this institution has become stronger. So the question to me, it is no longer can we raise capital, but can we protect, preserve, and grow that capital in the digital era? This is the question I think we should ask ourselves. Because today, if you look at it, the big threat to the capital and return on equity. It is no longer about non-performing loans, inflation, or FX volatility. But it is about the technology resilience, the cyber threats, the service availability, and digital trust, because you need to build this to grow that capital. And AI can help us improve in terms of growing the capital in the revenue generation, productivity, decision making, and more visibility to what we do. We can provide personalized services to our customers, and that's what the young population needs. Many of our Gen Z today, they don't know going to the banks. They don't know checkbook and so on. They open accounts without being to the bank. They operate and transact without going to any bank. And also today, the banks is not about your branch networks. It is about your digital offerings, using digital channels to reach your customers. So when we look at all this, the trust is at the center. That's what will make your customer to use and trust your services. And the only way you can build and sustain that trust is through regulation. Because regulation is about protecting the consumers as well as helping you as a provider also to do more. And if we are digitalizing everything, that means the regulation also need to be digital. And I think that's why we are talking about the RegTech.
Yes.
Because the RegTech is what will help us to preserve that capital. It is what will help the banks also to save costs in terms of compliance. You can use technology to have end-to-end visibility of your service delivery to customers, as well as you can use that technology to comply with all regulations. It can also help in terms of building resilience, in terms of strengthening the governance in your institution. So regulation is very important, and regulation is not about stifling innovation. Because today we look at regulation as things that will help us to influence our customers' behavior, market, and economic behavior. So it's not something that maybe you have to start following commands from regulators. So you can use technology to expand that. And
but
today we are...
Sorry to jump in, DG. If I can just ask a question about what does that regulatory framework look like from your viewpoint right now? Can you just speak specifically to that?
Okay. From NIDA's perspective, we look at regulation from two angles. There is what we call a rule-based regulation and a non-rule-based. A rule-based is a normal regulatory instrument where a regulator can issue guidelines that everybody must follow and comply with. While a non-rule-based is where you watch your licensee to see how they build use cases and use it as a benchmark for best practice. Because technology is something new. It's not something we learned from the previous generation or from legal books, but it's something that evolved with time. So emerging technologies like AI, the solutions fintechs are building, is not something familiar to the industry. So the best way is for the regulators to work with these innovators, build solutions. When they build, they make sure as they are building, maybe they can encourage them to create new market, like the same way we created the fintech industry, or they can encourage them to enhance productivity in the existing business processes, or they can help them in like coming up with a new way of doing things. because there are things that are not possible without technology. So the technology can inspire you to come up with a new way of doing things. For example, if you look at Uber, before, nobody can imagine you can have the world's largest transportation service provider without owning a car. But with technology, using big data, using the mapping services and analytics, that what made it possible for Uber to matchmark someone looking for a car and a car owner to provide a transport service for him. So that's what the fintech is doing as well. Before or pay, before money point and so on, nobody will imagine I can open an account without going to the bank, with just using my mobile number and so on.
Right. Let me use an example. I began to appreciate this more as I prepared for this. Algorithmic bias comes in sometimes when some providers are trying to acquire customers, try to assess them and so forth. I think these are some of the concerns that a lot of people have. And I wanted to hear your thoughts about how an institution like yours can help to protect consumers from such things.
So we look at it from different ways, and also sometimes we promote joint or converged regulation, because these are things that cut across so many institutions. For example, we look at it like these days with the digital financial services. How can we expand the financial inclusion to get SMEs to access credit from banks or even other lending providers? Mostly the banks, they don't give SMEs loan because of the risk involved in giving them for them to pay back. They don't have visibility of how they run their business. They don't have collateral and so on. But is the collateral more important, or the revenue the SME is generating? If you look at it, the revenue is more important, because collateral cannot pay back loan. You can only pay back your loan through your revenue generation. So can we use technology to create more visibility, to come up with like a credit scoring platform using AI that can help these SMEs build knowledge in terms of financial management, bookkeeping, and so on, then make that information available to lenders.
Right, but DG, the point I'm making is that even in that process, there could be bias. So, for example, does NITA have regulations around how that process should go? Is NITA checking what others are doing, what some of these providers are doing? So I guess that's the heart of the question.
So NITA regulates technology in general, but we have sector-specific regulators.
Okay.
For example,
so really, the burden is on them.
Yes. So in AI, what NITA did, we developed the national AI strategy. Under the national AI strategy, we have a pillar on adoption, sectorial adoption of AI. How can we adopt AI in financial sector, in health tech, in agri, in education, and so on? So NITA cannot issue a regulation for AI adoption in financial sector without working with the Central Bank of Nigeria. Likewise, in education, we need to work with Minister of Education and so on to issue that sector-specific regulation. So our regulations are mostly general purpose, the same way the technology is general purpose. You can apply it in different sectors. For example, we are working with the ecosystem to come up with standard guidelines on sovereign cloud infrastructure, which is not specific for any sector, but for the national cloud adoption and building our national sovereignty on cloud infrastructure.
What does that look like now, if you can just be more specific?
So, for example, we have data classification under the National Cloud Guidelines. The data classification categorize data, which data must stay in country, which one can go to public cloud, and which one you need like a waiver to put it on the public cloud. Right. So the Central Bank of Nigeria is latching on this to come up with also sector-specific regulation that transaction data must stay in country.
Got it. Thank you so much for that insight. I want to go now to Professor Yinka David West. You've been listening up to this point, and I want us to dive deeper into these ethical issues around AI adoption. I want to hear your perspective on that. What are the ethical concerns that arise for you as we continue to deploy AI?
Good afternoon. Good afternoon, everyone. So I'm going to speak from different lenses.
Sure.
Right? So I'll speak from a teacher lens. I'll speak from a former banker lens. I'll speak from a co-creator of the National AI Strategy and my new role, which is running an AI scaling hub. You know, ethics is ethics, right? And you talked about algorithmic bias, but I'll also say that we all have biases, unconscious bias. There's some of us that say, oh, my daughter can't marry someone from X because they're not from my village. It's a bias. So let's not take away the fact that whatever we're seeing with technology comes from us.
Sure.
And that's why when we're talking about biases, we can't eliminate biases 100%, but we can reduce them based on very strict testing and based on the whole flow of developing the AI solution. So if, for example, you have a group of young men, white Caucasian men, building an AI solution, and they're training the solution, they're going to train it based on their own
culture,
values, culture, experiences, etc. And we saw that the other day, I think in the UK, where they had a facial recognition system that did not recognize women and did not recognize non-Caucasians. So those are the types of biases. And I think that there is nothing saying that we can't relearn or reprogram, but it's just being mindful that when you create these solutions, they now become exclusionary rather than inclusionary. So how do we ensure that we're putting all the dots in place to ensure that we can make them inclusive? And that's where AI governance comes in. When we developed the AI strategy, it was really not about being dogmatic about you must do this or do this or do this, right? It was more of a principle base. These are the guiding principles we want you to adopt. Fairness, responsible AI use, ethical considerations, etc., right? And then we expect different levels of governance. There's self-regulation. You should know that, oh, I want to serve Nigeria. Is my solution pan-Nigeria? I want to serve Africa. So you don't need a NIDA to tell you that. Right? So self-regulation is the first. And then the second is guidelines and compliance. So where we have the regulatory authorities actually now looking into, but don't forget that regulatory authorities too can't look into your entire sample. If we're doing how many billion transactions a day, you don't want to create another bottleneck that says, oh, until you pass this hurdle, you can't transact or you can't work. So it's also about how do we ensure that we're sampling appropriately and ensure that we're putting the right frameworks in place. The third is how do we ensure that people are deploying guidelines?
Right.
Because you can deploy, and did you know
what isn't checked doesn't get done.
Guidelines, people don't have to use them. So it's really that check and balance. But I believe that if we, first of all, decide that we want to be responsible in our own business practice, then it should be much easier. But some of us want to take the shortcut, right? Because we know that, oh, this is the shortest route between my success and my competitor's success. So it's many things, but the ethical route is something we need to think about. Governance standards and strategies. How do you ensure that your boards who are approving the expense also know what they're approving? Do we have the right checks and balances in place to ensure that, oh, when you retrain a model, does it now create new risks or new biases in general?
Right. But even the journey into AI, I guess it's a learning process for everyone. And I wanted to hear your thoughts on the delicate balance between regulating and allowing innovation to flow.
So let me flip the question. What are you regulating?
Well, I think that the concern is bias, for example.
Mm-hmm. Sorry, bias?
Yeah, bias. Bias is something that people are concerned about.
So how will you know there is bias?
I think that it's obviously situational. Exactly. But then I think, for example, on the, should I say, credit side, there are some people that feel left out.
Okay. So if we look at credit, for example, there's already bias in credit. Mm-hmm. And you don't even need AI to put bias in credit. Because when you think about it, the financial institutions, what is their main concern? Risk.
Right. They want to get their money back.
They have to get their money back. It's shareholders' money. It's not free
money.
Indeed. So their main concern is risk. So at the end of the day, I'm going to lend to people I believe have the ability to pay and the willingness to pay. So if you have the ability but not the willingness, I can't lend to you. And don't forget that, the way we've sort of structured Nigeria, it's not just the ability to give a loan. What is your credit recovery process? It's still very high touch. So when you say, oh, I should go and lend to the woman who is selling corn on the Lekki-Ekpe Expressway, okay, it's easy to shoot money to her. But as you said, as she's selling every day, right? She's selling in cash, remember? Mm-hmm. How does she convert that cash into digital to ensure that I can be collecting my money back? Without that money sort of taking a twist, because one brother came from the village and said, oh, we need to pay hospital bills and we need to do this and we need to do that. So it's also the collection infrastructure. When you talk to the likes of the microfinance banks and LAPOs and stuff, that is the machinery they have to put in place. Because that is costly.
Indeed.
Then when you now say, what is the other problem with credit? It's expensive. Okay? How do you make it cheaper when you have to put boots on the ground and go door to door knocking? And with online credit, another problem, Wale, is that a lot of people believe that it's free money. You just press your phone, right? And you get money. Right. So a lot of them don't even have intent to repay.
I hear you. It's a delicate balance. Okay. All right, let me go to Mr. Oshinobi, who is the Africa Advisory Leader at PwC. So you are obviously helping many operators, regulators, innovators live in this new world of innovation. Maybe my first question to you will be, why is your role so important to this whole process?
Okay, thank you very much for that. So a point of correction first. I'm not Mr. Oshinobi. So Mr. Oshinobi is not available. He couldn't make it.
Oh, I apologize.
And I did the tech business.
Sure, of course. Thank you for clarity.
So in terms of why is our role important, right? If you think about it, if we focus on artificial intelligence now, right? Organizations are using artificial intelligence. We all know that already, right? The challenge most people are seeing, right, is that a lot of people are in the pilot and experimenting stage, right? That's one. Number two, you also notice that people are saying, I'm deploying artificial intelligence. However, I'm not getting the return on equity or the return on my investment. So our role, right, as advisors, right, is to help organizations see a picture. What is the picture that we're helping them to paint? The first one is, if you have capital, what does it do for you? Your capital is to help you building capabilities. What are different types of capabilities you can build? Artificial intelligence is one of them. Talent is one of them. Data is one of them, right? After you've gotten your capabilities right, we also work with organizations to say, how can you be a lot more resilient?
Yes.
Because what that does, it helps you improve your confidence. If your systems are not going down every time, your services are not going down every time, you will make money. So it's us working with clients to connect the dots from capital, capabilities, right? Improvement in confidence and resilience, and helping them see how can they turn this investment, right, into money. Yeah. I think that's one important role we play for private organizations. When it comes to our regulators, right, what we support them in doing is in assisting to say the regulations that you are putting out there, right, ensure that there are regulations that don't stifle innovation. Because if your regulations stifle innovation, then at the end of the day, nobody's gaining, the economy is not gaining. So our work also in supporting our regulators is to say, these are the things you should focus on. These are the things that are important. We also inform them things like, don't try and regulate bias. You can't do it. Come on, like, it's ridiculous. Sorry, I'm sorry to say.
All right, so thanks for...
That's what we do for organizations and regulators.
No, it's an interesting point you're making, especially, very often when we think about some of these points like bias, it's from a certain lens, and perhaps it doesn't consider the full picture of all the moving parts. We'd like to open this up to the audience. If you do have questions or comments, please, just like the last time, signify by raising up your hands. I do see a hand here already. I see another hand over there. Do we have a microphone moving through the room? Please, if you can be very concise with your questions, introduce yourself. Okay, you need one of them here? Okay, sorry. Can we just... Sure.
Good afternoon. Abdul Razak Oluwaseun Raji.
Sorry, yeah, which firm?
Abdul Razak. ProEco. We're a renewable energy firm.
Renewable energy
yes,
firm.
Yes.
Okay.
My question goes to Mr. Coker. What solutions, especially you were talking about diesel generators, aren't you thinking of going more sustainable, adopting renewable energy solutions for your data centers?
Okay, so in terms of their energy source.
Energy, yeah, energy sources.
Okay. All right. Interesting point. Do we have any other questions before we go to the panel? We have another hand here, and maybe we'll go to the back after this.
Hello. Good afternoon. Mogaji Olanwaju, Go Viral AI Lab. Go Viral AI Lab.
Okay.
We're currently here as Money Labs. We're giving AI agents the ability to pay and transact. My question goes to you and you. With regards to localization, which is something that we're doing for businesses, how exactly do you see integrating companies and helping them localize in terms of cost structure? So I'm trying to see if something we could work with you people to help our clientele localize. What does cost structuring looks like for localizing AI? Yeah, fintech companies cannot build AI and send information out. And there's a regulation now that ensures that every AI agency that you use that is third party, every data that you put in is no more yours the moment you put it in. So how exactly are we seeing this play out for businesses as a whole?
Okay. Let's take those two questions before we go to the back. Are you...
Okay, on the
your energy
sustainability, renewable energy one, the first one. You see, something's happening around the world now where people used to say, oh, Africa, you don't have power and so on, to utility. Nobody has power to just plug into most places now. Because even if you go to a utility and I say, I'd like 15 megawatts, please, they'll think, that's not readily available. It'll take me X number of years to build it. So you have to plan that one out anyway. So there's a bit of a level up playing field right now. Now, in Nigeria, we have gas, we have hydro, okay? So typically, and around Africa, in abundance, you know, you've got gas locations, hydro, even geothermal, and so on. And even some countries in Europe now are seeing gas as the cleanest practical option of a fossil fuel if you're not going to solar or wind and so on. Now, the density of power requirement to underpin the infrastructure own power infrastructure, or you partner to generate the power you require, having the access to the raw gas. So you're like your own utility. And plugging into utilities, okay, to a point. We do that in Lagos, but we've invested in significant infrastructure that is our own connectivity to a distribution point. And then we have sophisticated power that steps it down to what we need. Okay? You also look at what is the utility using to generate the power to deliver to you. And if it's gas, predominantly gas is the practical thing here. And you see that build out significantly. Lagos State is already putting in frameworks for companies to scale up in terms of power generation, which is something we're looking at closely as well. Now, when it comes to diesel, no one wants to run a facility with diesel, right? You don't want it. It's very expensive. However, everywhere in the world as well, you have to have enough diesel generation as backup to what you're doing. And you need to be able to invest in it to full power level. It's what you need with 100% uptime, the kind of reliabilities that we require. So those are the practicalities and what we do as an industry on generating power. Now, you want it 0% diesel, that's ideal. But practically, even we're achieving quite high uptimes. No. Now, sustainability generally, it pervades everything we do as a business in so many areas. And you also have greenhouse gas reporting that's coming in, and so on, and the way we engineer. Give you one example. Even if you had the most green source of power, if your facility is inefficient in terms from a power usage effectiveness point of view, you're wasting green power on inefficiency. So we always make sure that the designs that we have are as highly efficient as they can be from a power efficiency point of view, given the environment we're operating. So we have 90, let's say 90, I call it the 90-90 challenge. 90 degrees Fahrenheit, 90% humidity. But you won't believe it, the engineering innovations that we have still give us pretty good efficiency despite that, in comparison to some of European data centers, for instance. Now, the other question comes to the data localization thing and stuff and so on. One piece of infrastructure I didn't talk about is something we call open access fabric. What this is it allows you to leverage the connectivity infrastructure that we have, linking through the subsea cables, and Lagos is very well served by subsea cables. We have the Google's Aquino cable here. We have Meta's To Africa cable, bringing in capacity through subsea cables. They make the internet work globally. You've got subsea cables everywhere. Go Google it, subsea cables, and see what the diagrams look like. Now, we now use that. We have a piece of infrastructure that allows companies to peer into, use that connectivity and connect you directly into the heart of all the major cloud providers, okay? But also into the heart of some of the local cloud providers, because we do have local cloud providers, right? What that means, as DG said, there's cloud classifications of what data has to be held here, what data is optional, what has to be approved, is that we can help organizations seamlessly link into their cloud efficiently to bring better efficiency in that processing. Or if, like the CBN has mandated, you now need to move data from there back to here, it helps you through the migration process. Or, having done that, you need to get a better balance between what you process here and what you process elsewhere. Because, let's face it, we live in a global data sort of governance environment now. So you can actually optimize between what you host and process in global clouds or regional clouds with what you process locally. Right. And so some of this infrastructure is there, sort of there in the background for companies to be able to leverage to make sure they operate efficiently in the way they use global cloud, global AI, local AI in optimizing their businesses.
Thank you very much. I do see other hands up across the room, but sadly, I have been told that I actually need to wrap this up now. So here's what we're going to do. We are going to lunch right after this, but I'm sure before we do, there's an opportunity to interact with our speakers, panelists. So I encourage you to do so, but unfortunately, I can't take many more questions just because we have run out of time for this. So please, if you would be so kind to give our panelists a round of applause. Very valuable insights, useful conversation. We can take this further right after this. We'll take a short photograph and then I'll make a few announcements before we adjourn. Okay, thank you. Thanks. Cheers. It's fine. It's fine. Thank you very much. Thank you again to our panelists. A very, very valuable insight. As they make their way off the stage, just need to run through a couple of things as we round things up today. First of all, I want to thank everyone for coming. Thank everyone joining us virtually, also listening in to the conversation we're having today. This gathering has been, if you like, a testament to the power of collaboration, where institutions, technology, and money converge to redefine possibilities in what we've been discussing today, the post-recapitalization era. I will not be able to do all of this today without the support of our generous sponsors, so I'd like to just, again, recognize Zenith Bank, FSDH Merchant Bank, Open Access, Money Point. Thank you so much. And also for our knowledge partner, PwC, our institutional partners, the CIBN and fintech NGR. Thank you all so much for your support today. Of course, I want to thank again our distinguished speakers, the ones that just spoke, and of course, those that were in previous panels. Thank you so much for your participation. Ladies and gentlemen, it doesn't end here. Again, as I encourage you, please connect with our speakers and make those valuable connections that will take the conversations that we are having today, not just ending here, but taking them to make a meaningful impact on your business, on your lives, and of course, on the broader environment here. I'd like to, again, encourage you to use the hashtag FOB. Just want to confirm it again. Yes, it's FOB Nigeria. Please, as you are sharing your photographs, your pictures, and your comments online. Again, as I mentioned, lunch is served right after this. Your in-code ticket will be your lanyard, so please, you will get some instructions as you leave to join us at the Red Restaurant on level 1 of the convention center. Thank you so much again to everyone for coming, for staying up to this point. We look forward to having you at our next event. Just to highlight some of them for you, there's the Invest Nigeria conference taking place on the 17th of September. Please look out for more information about that. And of course, the Stewards Capital Awards event, which would hold later on this year in December. Thank you again for coming, and we look forward to having you at the next event.